Welcome back to the European market open. A minute to go until the start of cash equity trading. Here are your headlines. OPEC Plus in crisis. Brent topped $77 for the first time since 2018. Saudi Arabia and the UAE failed to resolve their differences, blocking a deal to boost output. Reopening experiments. Boris Johnson lays out plans to end social distancing in England from July 19th. Personal responsibility replaces legal restraint, and work from home instructions will end. Plus, the final stretch. The ECB zeroes in on a compromise in its biggest strategy review in almost 2 decades. Officials begin their meeting today. Good morning, everybody. Welcome back to the second hour of the European market open. Just 12 seconds to go then until the start of Tuesday's trading session, and European equity market futures point to the downside, down by 0.2% or so. A bit of nervousness perhaps in markets over some of the developments in the oil space. We do have a higher oil price. We had a higher oil price yesterday, and we continue to see one. It didn't knock risk assets through the Asian session all that much. And in fact, we saw the dollar on the back foot, the dollar down by 0.2%. So it's not as if the market is rushing to that particular safe haven at the thought of higher oil prices. But of course, you do sometimes see those two things moving in opposite directions, oil and the dollar. So perhaps that makes some sense, but it adds something to that relationship. Let's think about where we are at the start of trade then. We've got the stock 600 down by 0.1%, the FTSE 100 down by 0.1%, the CAC 40 and the Xetra DAX both down by around 0.25% in the early moments of Tuesday's session. The Asian equity session then was fairly mixed. We're up by 0.2% on the MSCI Asia Pacific, but certainly oil and the movements of oil very much in focus today when we think about the top stories here for European equity markets. So European equity markets are opening to the downside, but very modestly so. OPEC Plus has been plunged into crisis. The alliance called off talks yesterday after a bitter fight between Saudi Arabia and the UAE blocked a supply increase. The deadlock has sent crude surging towards $80 a barrel. What happens next will determine whether the breakdown could escalate into an issue as destructive as last year's price war. Joining us now is Saka Nusseibeh, International at Federated Hermes CEO. Saka, very nice to speak to you. Are you in the camp that says, look, we're nearly at 80, we'll be heading to 100 soon, oil prices are going steadily higher from here, or are you a little more cautious about just how high this takes us?
I think I'm a little bit more cautious. Look, the key here is that the reduced capex spend on oil last year has put a cap on how much we have in supply reserves and inventories. I think inventories are stable. The demand is picking up, but is not yet picked up completely. This is all looking to the future. As the COVID restrictions slowly ease, you'd expect the oil overhang, or there isn't quite an overhang, the oil supplies to be taken up. And that, I think, is the story. Does it push it all the way up to 3-figure numbers? Who knows? Does it push it up a little bit more? Yes, probably. Is there an inflationary surge as a result of this? Yes. So I do see it going up, but not perhaps as viciously as others would.
What difference does this make, Saka, in terms of the inflation assessments? Because we're already a bit concerned about where inflation goes. The story has been around supply constraints and a mismatch between supply and demand in certain sectors that pushed up prices in some sectors, and big shifts in consumer spending patterns that have been difficult for economists to get their head around, and now high savings rates. And so there's a lot we don't understand maybe about where inflation goes, but this is certainly something that has pushed inflation higher in the past. What contribution will this higher oil price be making, do you think?
I think it's an indication of some more cause for higher inflation in supply prices. And as you rightly said, economists are slightly behind the curve in trying to understand how inflation will unfold this time around. It does look that, like I say, as things unfold, as we come out of COVID, spending goes up. We already have supply shortages in certain sectors in the manufacturing industry. We have the consumer changing the way they spend, but still spending as much and with high savings. All of that, to my mind, points to some inflationary push. Not necessarily inflationary bubble, but some inflationary push. And against that, of course, the central banks are worried because they're trying to keep monetary conditions as easy as possible for the time being to try to encourage this recovery, which they see it as nascent. It's almost like a little fire that you want to build up and you're sort of blowing at it. And that's what the central banks are trying to do at this stage. But to my mind, the oil price adds to the probability that we will see a rise in inflation. And ultimately, that means that you'll see an end to the abnormally low interest rate yields over time.
Yes, and if this is being driven by things that are not to do with the broader supply chain difficulties, so high demand for tech products or blockages at ports, you know, the oil story is different, it operates with its own dynamics. Could it mean that inflation is stickier? Because it's not just a case of how high inflation gets, it's how sticky it is when it gets to those high levels, Saka, of course.
So it could change its dynamic. I mean, I think it's an additional factor. The difference with this one is a disagreement about, in a sense, trying to meet the demand in the market between OPEC and OPEC plus. I think it's an indication that the world economic engine is moving faster. And that's why you're beginning to see this. The chip shortage, which we all know about, the higher demand for production of electronic goods, which we all know about, what you talked about supply chain being stuck in ports, all of these, the assumption that somehow they all smooth out assumes that we go back to normality. But there is an indication that, in fact, what happens is the demand continues to increase. And to my mind, this also feeds into it. Now, how much it feeds into it depends on whether they come to an agreement between themselves. By that, I mean the United States of America and primarily Saudi Arabia. If they disagree and you have oil prices boosting to beyond three figures, then you have something more of an inflationary shock. Even if they do agree and increase supply, the fact that capex was not as much over the last year puts a limit to how much they can bring to the market. So whatever happens, the supply is going to be slightly less than people realize. That then pushes up inflation, in my mind.
Saka, thank you very much. Stay with us. Saka Nusseibeh, International at Federated Hermes CEO. Stay with us here on this program. Coming up here on the European Market Open, China is allowing its $12 trillion credit market to undergo a wave of defaults, despite historically striving for stability in that market. How destabilizing is it, or could it be? We'll discuss that next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
Welcome back to the European Market Open. Just coming up to 9 minutes into our trading day, and European equity markets just on the back foot, down to around 0.25%. Let's have a look at some individual movers, though, because there are some decent-sized moves on these markets this morning. I'm keeping an eye on Alstom, the French industrial business, down by 7.5%. The CEO saying he expects costly months ahead, turning around Bombardier. They sealed that deal in January. They've taken on some problematic legacy contracts, and so that seems to be what they're dealing with. Over into the German market, so the German shopping market, and in particular drug stores, and Shop Apotheker falling by, let's see how much is it down by now, falling by nearly 12% after the company said its full year 2021 guidance was going to be challenging to meet, so the market adjusting to lower expectations there. And let's go to the FTSE 100 and British Land. This is an example of some of the moves we're seeing today in that particular space, in the real estate market. British Land in focus, down by 3.8%, cut by Jefferies to hold. We seem to have picked all the moves to the downside. Broadly speaking, the market down by around 1/8%, the FTSE down by 1/10%, but we do have these large moves for you to the downside on some specific news flow. Now, China's $12 trillion corporate credit market is the world's largest after the US, and until recently, one of the most stable. But as Beijing forces accountability on its weakest companies, a wave of defaults is ripping through the markets. Saka Nusebe, International at Federated Hermes CEO, is still with us. And Saka, how concerned are you about this? We've got this Bloomberg China credit tracker, and actually it says the sort of strains in the credit market, they put them in put at mid-range at the moment in the corporate credit market, despite the fact we've seen Huarong and Evergrande. It does seem as if the fallout has been fairly limited, but the direction of travel, according to our colleagues, seems to be clear, that the Chinese government is allowing further defaults. Is that something that alarms you in a China context?
Not necessarily. I mean, again, it's in the context of China. What they're trying to do is to control increased liquidity and to try to have better accountability. And this has been part of the Chinese Communist Party's sort of central tenet, that you bring accountability to officials. You've got to balance the defaults being allowed with something happening on the other side, which is the People's Bank of China essentially signaling very strongly that it will continue to allow easing of interest rates and more liquidity into the system. So the two are balancing each other. On the one hand, the central bank is saying very clearly it will keep interest rates low and might bring them lower. They've passed a rule that would allow them to ease them even further. The central bank is essentially allowing itself to inject more liquidity, and at the same time, they're allowing companies to default. What are they trying to do? They're still trying to pivot from being an export-led market to being a consumer-led market. They want to encourage new ways of raising liquidity, but that must mean, in their mind, an ability to allow defaults also, because that's a healthy way of weeding out people who do not meet the criteria of success as they see them. So, to my mind, this is a reasonable way of progressing, if you like, within China.
And sticking with the China theme, we've got an interesting big take story out on the Bloomberg this morning, Saka, which is asking the question, when will China rule the world? And the simple question you're trying to answer here is, when will China be the largest economy in the world? And you can get to a date that isn't all that far off from now. But if you put certain constraints on China, or if you can also craft a scenario where China maybe doesn't get there. But either way, it raises questions about the extent to which the US wants to, or might be forced to, share global power in some way. How do you look ahead to that important development?
So it's an interesting one. So the Chinese Communist Party celebrated 100 years, as you know, and it's clear to me that they are still yearning after power. In the Chinese historical sort of memory, is what they call the century of humiliation, essentially, which we, the Brits, were primarily responsible for, the century in which they gave in to foreign powers. I think the lesson they learned from 1992 and the fall of the Soviet Union is to be a strong military power, you have to be a strong economic power, and that's partly what pushed them. Now, the Americans are not going to be comfortable with that, and that is because China remains a centralist communist country, effectively. I mean, they behave in a way that allows capitalist growth for the economy, but they remain fundamentally different. They have a different set of values. And they are challenging, and I think the US military realizes they're challenging, and the United States realizes that economic power and military power are tied together. So there's going to be some tension between the two, and I think the US, in general, the Foreign Department in the US realizes that China is the big challenge for them in the future, and they will try to at least slow the growth. Because I think that the recent changes in China, and that is the ascendancy of President Xi's more communist-centric views, has outlined that there will be no convergence of values. When you and I started talking many years ago, there were some people who were saying, China is becoming more like the West, that eventually it becomes more open, more liberal, more democratic. That's clearly not the case. And China has been building its overseas influence by using economics, notably in Africa, and acquiring a lot of assets there that are necessary for technology in Africa.
And Saka, how does Europe chart a course through that tension between these two big powers then? I mean, we've got headlines talking about the meeting that took place yesterday between Angela Merkel, Emmanuel Macron, and Xi Jinping. This was a video summit. The headlines coming out of it seem to talk about flights and helping to establish more flights coming through between the two locations, sort of tinkering at the edges of that relationship, perhaps, rather than dealing with the fundamentals. How does Europe chart a course through this tricky time?
I think the reflection of what happened in this virtual summit is that Europe realizes, in terms of international affairs, it's got to have a slightly stronger position. Generally speaking, Europe tends to be very cautious in its foreign policy and to try to chart its own course of trying to build economic relations and to at least be on a footing of negotiations with the Chinese at this stage. And the reason is that whatever happens, the share of China's economy of the world economy is going to grow, and that is important for European export markets. There's a dependency on a lot of raw material that's necessary for technology production coming out of either China or Chinese companies. That's also important. And I think the Europeans have long believed that the ability to negotiate gives you an ability to perhaps influence economic power. But you're right. In reality, you still have two blocks, two major militaries, and that's going to be the standoff. And that possibly might argue for more instability than perhaps most investors in the world are used to in the coming 20 or 30 years as this rises to the fore.
Saka, thank you very much. Thanks for coming to talk to us this Tuesday morning. Saka Nusseibeh, International at Federated Hermes CEO. Saka will be continuing his conversation with us on Bloomberg Radio. I'll be heading there, 9 a.m. UK time. Let's get a Bloomberg Business Flash. Here's Laura Wright.
Thanks, Anna. Buyout firm Bridgepoint Group has confirmed it's going ahead with a London IPO. It's filed its intention to float document after announcing last week it aims to list at least a quarter of its shares to raise around £300 million. The UK private equity company invests in middle market firms across Europe. It has stakes in Burger King franchises and in Itsu, the Asian-inspired food company. Ocado has signed an agreement with Auchan to develop the retailer's Alcampo online business in Spain. The companies will initially build a customer fulfillment center to serve the Madrid region starting in 2024. Separately, Ocado has reported EBITDA for the first half ahead of the average analyst estimates. China's antitrust regulator is said to be about to formally block Tencent's proposal to merge with two top video game streaming sites. Reuters reported that the company hasn't figured out how to meet government requirements on giving up exclusive rights to the content. Officials announced a review of the $6 billion transaction in December last year. That's the Bloomberg Business Flash. Anna.
Thanks very much, Laura Wright, with your Business Flash there. Coming up on this programme, UK Prime Minister Boris Johnson plans to end all social distancing and make face masks voluntary from July 19th, saying people must learn to live with the virus. We'll bring you the latest next. This is Bloomberg.
balance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
President Macron has always been clear that he will not stop reforming the country because of COVID or whatever.
When I was an MP 20 years ago for a previous reform, we had proposed a system for those who started working very early, at 14 or 15 years old. They cannot go until the end the same way, because they're worn out by a lifetime of labor. Without justice, reforms cannot pass.
The president is clearly on the path of continuing the reform, and I think he's right, because even though the political agenda, the elections may be short term, what we need is structural reforms anyway. So if we don't pass them now, when they are required and needed, when are we going to pass them?
The pension scheme is not balanced, it's not financed yet. That means that the younger one pay for the older one, but they don't have the insurance at all that they will benefit from the pension scheme at the level of the older one. And this is absolutely unacceptable.
I will present my retirement reform. I will present my own, and there will be justice in it.
French government and business leaders there on President Macron's plans to revive a controversial pension reform that he had to abandon during the pandemic. He'll be meeting with Labour representatives today, so that puts those events or those comments very much in focus in the French diary. Let's think about the global picture, the global diary now, and some of the events that we're watching here today in global markets. At 10 a.m. London time, we'll get Eurozone retail sales recorded for the month of May. The data is expected to show an increase of more than 4% over the previous month. Germany's ZEW survey will also be out at the same time. It will report the latest outlook for the German economy. ECB policymakers will hold a special meeting in a bid to complete the strategy review. We discussed that a little earlier on in programming, the expectation there of more dovish policy. And finally, the annual Sun Valley Conference is set to return after being cancelled during the pandemic. Mark Zuckerberg, Warren Buffett, Jeff Bezos, all expected to attend at what's known as the Summer Camp for Moguls. Now, Boris Johnson has announced plans to end social distancing in England from July the 19th. Final decisions due on July the 12th, but this is the direction of travel. Face masks will be made voluntary, and the government will no longer instruct people to work from home despite a surge in infections. Joining us now for more is our news director, David Merritt. David, very good morning to you. So we were warned yesterday when we got this announcement that we would see a further wave of infections, maybe 50,000 a day by the time we get this further unlocking on the 19th. But there was this suggestion that we've managed to lessen but not totally break the link between infections and hospitalizations and deaths, mostly through the rollout of the vaccine. So is this a big gamble that Boris Johnson is taking here or not, given the relatively high level of vaccination?
Well, you know, it has to be a gamble in the sense that we are in uncharted territory, of course. You know, the previous lockdowns, when we've seen this sort of uptick in cases, the sort of numbers that you were just talking about, that's been when the government has had to reluctantly tighten restrictions and prevent people from leaving their homes and shutting down businesses. And we're in the opposite case because, as you say, the argument goes that they've weakened, although not cut, they said, very pointed yesterday, but weakened the link between hospitalizations and deaths. But of course, we know that hospitalizations and deaths follow on some weeks after a big uptick in cases. So there's still a sense that while they're pretty sure we're not going to see the hospitals overwhelmed, they don't know for sure. And there are plenty of scientific voices out there warning that this is a reckless move at this point, and that in fact we may be storing up trouble to come. And while the government is pressing ahead on this, as I said, there's an increasing clamour for a little bit more caution, perhaps. And some people are very concerned that we're going to see the country slipping back into some of the terrible scenes we saw earlier this year with hospitals full and death rates increasingly high.
Yes, so we'll hope that that link has been lessened enough to stop that from happening, to stop what you describe, David. In terms of the business response here, then, we do see the government stepping back from the previous guidance that work from home was the kind of mandate, I suppose, if it were possible. But we now see a request for more information from those businesses that are going to be a little confused what to do with the mask mandate being dropped. How do they protect their staff at the same time as allowing freedom to people to make their own choices and to take personal responsibility. So are businesses happy then with the further relaxation of rules?
Well, businesses like certainty, as we know, and I think this kind of tipping of the responsibility away from government rules onto individuals and individual businesses to make their own decisions, I think we can probably assume that's going to lead to lots of confusion and some chaos, I think, in some respects. What are employees going to demand in terms of the safety in the offices in order to get them back to work? What we've seen throughout this pandemic is actually the public have watched very closely the infection rates, and I think they've made their own decisions about whether they want to stay at home or whether they feel comfortable, say, going on public transport. If rates are going to hit 50,000 or more a day, are people really going to feel comfortable sitting on a crowded bus or a tube where many people around them are not wearing face masks? I sort of doubt it, really. So are we going to be able to get people back into city centres to revive those areas, things like all the hospitality around them, or not? Yes. It seems like confidence is going to be key here. And I think while the infection rates remain high, whatever the government says, that's going to be difficult to achieve.
David, thanks very much. Our news director, David Merritt, thanks very much for joining us. So when we come back, we will deep dive into the UK housing market. The Purple Brick CEO will join us next. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong. Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend now, but in the kitchen I have many friends.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Welcome back to the European Market Open. Just 8:30 here in London, and things improving just a touch. We are flat across European equity markets, which is a little more positive than around 15 minutes ago. So we're flat. We are positive just on the FTSE 100, a little bit negative on the DAX and the CAC still in Frankfurt and in Paris. Let's have a look at the sector breakdown then, and I can tell that we are predominantly in the red in terms of the balance of sectors moving higher and lower. We are mostly seeing sectors move to the downside. Autos and parts, the biggest falling sector once again, weighs no doubt on Germany. Insurance also a little bit under pressure. Energy and basic resources, though, move to the upside, which goes some way to explain why London outperforms today, eking out some positive territory. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. OPEC Plus has abandoned its meeting without a deal, tipping the cartel into crisis and leaving the oil market facing tight supplies and rising prices. Delegates said talks failed to resolve a dispute between Saudi Arabia and the UAE, which was the lone holdout against the plan to boost supply but extend quota limits until the end of next year. That means production will not increase in August, though talks can still be reactivated at any time. The leaders of Germany and France are urging China to allow more flights from Europe as a way to strengthen political and economic ties. The three-way video summit also discussed cooperation in Africa and global vaccine supply. An official said the leaders agreed there is a window of opportunity to revive the Iran nuclear deal. Facebook, Twitter and Google have reportedly warned they may stop offering their services in Hong Kong if the government goes ahead with planned changes to data protection laws. According to Dow Jones, the three were part of an industry group that raised concerns to the government in a private letter. They claim rules to address what's known as doxing, where private information is revealed publicly, could put staff at risk. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London with your First Word News update. Let's get to the UK housing market story. House prices in the UK have surged by over 13% in the year to June. That is according to the nationwide house price index. That's being driven by cheap mortgages and a post-pandemic desire for more space. The buying frenzy has been reflected in a strong end to the fiscal year for the online estate agency Purple Bricks, which has posted revenue ahead of estimates this morning. Joining me now is the Purple Bricks CEO, Vic Darby. Vic, nice to speak to you then about the UK housing market. So I cited there the nationwide house price index, annual house price growth of 13.4% in the month of June. What's the house price growth that you've been seeing, that you see in your books at Purple Bricks?
Yes, good morning. Well, certainly we're seeing a very healthy and buoyant market stimulated by the stamp duty holiday over the last 12 months. We've certainly seen house price inflation stimulated by that in excess of 10% over the year. And as you quoted the numbers in June, certainly over 13%. So I think, from our perspective, we have seen a very healthy and buoyant market, really stimulated by two things. So one, the stamp duty holiday, but secondly, we are going through this once in a lifetime reassessment of housing needs as we all lived and adjusted through the pandemic. So we're starting to see, or we have seen over the last 18 months, an exit from major conurbations. We are seeing people reassess their housing needs, specifically around gardens and office space. And we believe that because of that, the market will remain resilient over the next 12 to 18 months, but we'll certainly see the true health of the property market over the next 12 to 18 months.
Right, yes, indeed, because we have seen, as you suggest, some support coming through from some government measures and the stamp duty holiday making it cheaper to move than it would otherwise have been, Vic. So what is your expectation that the unwinding of that particular incentive will have on markets? So as we see that stamp duty holiday removed, what kind of either damage will that do to the business of buying and selling homes? What kind of shock are you expecting?
Yeah, so the stamp duty holiday runs till the end of September, albeit it's being tapered now, so the savings that you can make are significantly reduced. I would say we are still seeing conditions for a healthy market. We've seen low interest rates. As you know, in April, the government introduced the mortgage guarantee scheme. We're talking about this reassessing of housing needs that people are currently going through as we're adjusting to a new working life. Interestingly, we ran a survey at the beginning of the year, and 20% of home buyers and homeowners have no intention of going back into the office over the next 12 to 18 months. So I think from our perspective, we are seeing the conditions for a very healthy and buoyant market. And I think the unwinding of the stamp duty is not going to impact that. I think the only other thing to mention as well is there is an imbalance of supply at the moment as homeowners really adopt a wait and see approach. So I think from our perspective, we'll continue to see house price growth. I don't think 13% growth is sustainable for anyone in any instance. So I think from our perspective, we may see a cooling of house prices, certainly over the next 12 months, but we believe that the market will remain resilient, and certainly we're looking to see a correction of the imbalance of supply versus demand over the next few months.
Okay, just to hold that thought for a moment, Vic, another market that's trying to find the right balance between supply and demand is the oil market. I just want to break into our conversation to alert everybody to the fact that WTI crude has now risen to the highest level since November 2014. So you see an in-session gain in WTI of 2.3%. 76 is the handle there, 76.87. We continue to see moves to the upside in oil prices as a result of the collapsing talks at OPEC+. The Saudis and the UAE not managing to come to an agreement on the base rates of production from which changes are made. That's the oil story. Vic, back to our conversation around housing. How does the London market compare to the national picture then? Because you pointed out that priorities changed around gardens, outside space broadly, and indeed home offices. Where has that left London, and how much of that trend of the last year and a half would you expect to reverse as we start to see people coming into city centres, perhaps a few days a week, maybe even 5?
I think that's right. So I think, we're seeing the easing of restrictions announced yesterday. We do believe that will stimulate different working patterns, albeit, we firmly believe in all the research that we've done that we're not moving back to working from office locations 5 days a week. Certainly in the data that we see through a number of consumer surveys that we've run is that consumers are now looking for properties up to 70 miles away from their office locations, and that firmly says to us that people will start to work more flexibly, that we'll see people going back to the office certainly 2 to 3 days a week. But as we know, people have not only adjusted to a new working lifestyle, but they're actually enjoying it, and they're a lot more engaged, they're a lot happier. And I think the days of going into the office, presenteeism and working 9 to 5 are long gone, and that's certainly what we're seeing at Purple Bricks. We see it within our own office environment, but also we see that within our customers and the consumers that we work with. What that means for London is that we are seeing an exit from London. If we look at our own data over the last 12 months, 8% of the houses we sold nationally are to people that formerly lived in London, so that's quite significant. As we also see, when we look at house price growth over the last 12 months, that's only around 3% compared to the national average of 13%. And we also know that whilst houses in London are selling very quickly, apartments without gardens, as an example, are not moving as quickly as people start to adjust their lifestyles and start thinking of their housing needs in a very different way.
Yeah. Let me ask you about how you are evolving your business model, Vic, at this time. You've been a bit different to the rest of the real estate market in the UK. You've had an upfront payment model, so if you want to sell your house through Purple Bricks, you pay an upfront fee. I know, though, that you've been looking at that, you've been evaluating that and thinking about how you can evolve that proposition. Have you decided to change it, or will you?
Yeah, we have. So today we're announcing that we're launching a money-back guarantee. As you know, we offer consumers a significant discount versus the traditional high street agent. So we only charge £999. If you look at the average house price and the average commission in the UK, it's in excess of £3,500. So we continue to offer our consumers value for money. I think the one thing to say is, as we look to extend our market leadership and look at some of the barriers to further adoption, I think the key consideration for us is that at any point in the UK, 30% of consumers consider using Purple Bricks. We have the market leading brand strength. We're also the most familiar brand in the category. But there are some barriers for certain customers that still remain. And in order to extend our market leadership and grow to our stated objective of 10% market share of the UK residential property market, then it's important that we evolve our proposition. So we are today announcing a money-back guarantee, so that if we do not find you a buyer, we will reimburse the upfront fees paid by our customers. And for us, that will create the sense of accountability that perhaps for some customers hasn't existed over the last 5 years.
Okay. And clearly, you mentioned how you're able to, you mentioned how you're different from, you have been different, or we've been talking about how you have been different. One of the ways you're different, of course, is you don't have a presence on high streets. You don't have to pay for that real estate. You don't have to pay for offices. I wonder what your staffing levels are like compared to other businesses within this space. You know, if I phone up and try to get appointments to view properties, is it, do I have to wait longer with you than with others because you don't have as many staff? What kind of data do you collect on that, Vic?
Yeah, so we look at that on a daily basis, and I'd say absolutely not. So one of the key metrics that we look at is 0 to 2-day availability, which is one of our leading indicators of availability nationally. So we have over 800 agents across the UK in every single postcode. We operate out of 126 outcodes. We have over 800 agents within those communities as local property experts that have an intimate knowledge of all of our local communities. And for us, it's just a different business model. So we don't have bricks and mortar, clearly, but what we do have is we have local agents that really understand their area, that are working from home. And for us, it really taps into what we believe is happening at the moment, and certainly has happened over the last 18 months. And certainly consumers now understand that, right? So I think, you know, if one of our key barriers was potentially a perception of our lack of local expertise over the last few years, certainly that's dissipating, given that everyone is adjusting to the new environment of working from home. And actually people can understand that you can be very, very productive from working from home. So clearly our model is that we don't spend money on bricks and mortar. We don't think it's that relevant in the modern day. Very rarely do you see people walking into high street estate agents today. For us, 97% of consumers start looking for property online, and you know, clearly it very much plays into our online model.
Vic, thanks very much. Thanks for joining us. Purple Bricks CEO Vic Davey, thanks for giving us your time today. Coming up on this programme, China's Communist Party sees the country's economic primacy as inevitable, but is it? Today's Big Take examines when and if China will be the world's largest economy. We'll have details next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We're seeing cases rise fairly rapidly. There could be 50,000 cases detected per day by the 19th. And again, as we predicted, we're seeing rising hospital admissions. And we must reconcile ourselves, sadly, to more deaths from COVID. We have to balance the risks. The risks of the disease, which the vaccines have reduced, but very far from eliminated, and the risks of continuing with legally enforced restrictions that inevitably take their toll on people's lives and livelihoods, on people's health and mental health. And we must be honest with ourselves that if we can't reopen our society in the next few weeks, when we will be helped by the arrival of summer and by the school holidays, then we must ask ourselves, when will we be able to return to normal? We will change the basic tools that we have used to control human behavior. We'll move away from legal restrictions and allow people to make their own informed decisions about how to manage the virus.
The UK Prime Minister there, Boris Johnson, announcing changes to the UK's pandemic rules. Now, China's rise has been meteoric, but will it overtake the United States to become the world's biggest economy? And if so, when? Few questions are more consequential when whether you're an executive plotting future profits or politicians manoeuvring through geopolitics. Today's Big Take is a deep dive on the Chinese economy, looking at its potential rise to dominance. Joining us now to discuss is Eric Zhu, economist at Bloomberg Economics. Eric, very nice to have you with us. So I've seen a few economists put dates on this. Many people have dates around this, and some of those dates aren't all that far off. So will China then overtake the United States as the world's largest economy? What are the dates you're thinking about, Eric?
Well, the short answer is it may happen soon, but it could never happen too. So it depends. So to answer this question, we have, estimated the long-term potential growth for both China and the U.S. And based on that, projected when China could, overtake the U.S. as the _1 economy. So a couple of key factors are going to shape China's potential growth. So like the fertility rate and how old people can work until they retire. This is going to, determine the labor growth. Then the China's domestic reforms and what's the possible extent, of isolation of China from the outside world, particularly the potential U.S.-China decoupling. It's going to, shape the China's productivity growth. So I think a couple of key factors, and we have made assumptions trying to explore the base case, upside scenario and downside scenarios around these assumptions. So in our base case, if everything goes on track, so we project that China could overtake the U.S. Like the start of the next decade. But that's far from guaranteed. So if those factors, are not going as well as China is planning, so if those factors are against China, then probably in the downside scenario, we will never see China do that.
Okay. So that's interesting. So a lot has to do with the birth rate and some of the other challenges that you mentioned that could stop China from overtaking the United States in the intervening years. What will the Chinese government be thinking about doing to address that? We've already seen them taking a different stance when it comes to birth rate, for example.
Yeah, I think definitely the government is already actioning, trying to address those challenges. So like they have recently relaxed the three-child policy. Although we don't think that will move the needle much, but I think it's at least a good sign that the government is trying to, push forward more policy changes, trying to encourage births and encourage, more employment, and also the delay of retirement age is being discussed. So this could be implemented very soon. And on the domestic reforms, we think President Xi already had quite ambitious blueprint since he took the power.
So lots of things have been discussed, what kind of reforms China should do. So I'm not going to repeat those things here. I think the key is how they are going to deliver and how soon it's going to be delivered.
Eric, thanks very much. Thanks for bringing us the analysis. Eric Zhu, economist at Bloomberg Economics. And of course, if you go to NI Big Take on the Bloomberg terminal, you can get further details, all the background research that has gone into that piece around when and if China overtakes the United States as the world's largest economy. 8:50 here in London. Coming up on this programme, we'll be back to the markets and what's driving them today. We'll focus in on the New Zealand dollar, jumping on rate hike bets. We'll also focus in on oil prices, of course. The WTI price, $76.94, nearly over $77 a barrel on WTI, up by 2.4%. More on all of that next. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open, 8:53 here in London, and European equity markets fairly flat as we wait for the United States to rejoin the global equity trade today after their holiday, their market holiday yesterday. Let's talk to Ven Ram from our Markets Live team, who joins us now with insights and analysis. And Ven, I'm really interested in what you think about oil prices. WTI rising to the highest level since November 2014 during this program, up by 2.4%, nearly with a 77 handle on WTI. Some people are talking about an oil price of 3 digits. Do we think we're heading there?
I hope we are not heading there, because that will be very negative for inflation. But, you know, an $80 a barrel is definitely looking imminently possible. And, you know, there is hope that the U.S. with Joe Biden, there will be renegotiations. And nobody wants a price war at this stage, as happened last year. And there is hope that the talks will be restarted maybe in a fortnight's time. And that will cap any gains going forward immediately. Anna?
And let me think about what's happening with other central banking narratives. And we had the RBA overnight. What is that telling us about the exit from monetary policy that's been brought in during the pandemic? Do we learn any lessons from their use of, well, yield curve control and slight tapering of their support?
Definitely. I think the RBA seems more confident about the economic recovery that Australia has seen, despite the lockdowns that they have had recently. And that's clear from the tapering of bond purchases that you mentioned. They've pedaled back to 4 billion Australian dollars from $5 billion now. And they also retained the April 2024 bond as the yield target, which was also more hawkish at the margin because there was speculation that the RBA may change that to the November 2024 bond. So that definitely supports the Australian dollar at the margin. We had Governor Philip Lowe saying that, look, we are not going to raise rates until there is a convergence of actual inflation as opposed to forecast inflation meeting our target. And the central bank envisages that this won't happen before 2024, albeit I think that's a moving target. I think they may actually increase rates before 2024. And that's definitely hurting up the Australian dollar today.
Yeah, thanks, Ben. Thanks for giving us your time. I know that the Australian dollar, the New Zealand dollar, also jumping on better data out of New Zealand, bringing forward expectations of when we see a hike in interest rates there. Thought I'd better mention that as we said we would in our conversation. Ben, thank you very much for joining us. Ben Round from our Markets Live team. That is it for the European market open this Tuesday morning. Surveillance early edition is up next. We have, of course, European equity markets then an hour into their trading session, not going anywhere in a hurry. US futures after being closed yesterday. US markets could be a touch weaker. They're fairly flat, though, US futures this morning. This is Bloomberg.
could be 50,000 cases detected per day by the 19th. And again, as we predicted, we're seeing rising hospital admissions, and we must reconcile ourselves, sadly, to more deaths from COVID.
So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives. It no longer paralyzes our nation.
And to those who say we should delay again, the alternative to that is to open up in winter, when the virus will have an advantage, or not at all this year.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on Tuesday, the 6th of July. I'm Francine Lacqua here in London, and here's what's coming up on today's program. OPEC talks break down the conflict between Saudi Arabia and the UAE, blocks the cartel from agreeing an oil supply increase. WTI crude hits its highest in 2014. The English experiment. Boris Johnson says England will end social distancing, capacity curbs, and work-from-home guidance on July 19th. And the ECB enters its final stretch of its biggest strategy review in 2 decades, with climate change and the labor market on the agenda. Well, Bloomberg learns talks may culminate in an announcement this week. So welcome to Bloomberg Surveillance Early Edition. Quite a lot going on. OPEC Plus has plunged into crisis. The alliance called off talks yesterday after the bitter fight between Saudi Arabia and the UAE blocked a supply increase, sending crude surging towards $80 a barrel. Now, what happens next will determine whether the breakdown could escalate into an issue as destructive as last year's price war. Well, joining us now to discuss this further is Will Kennedy, our executive editor for energy and commodities. Will, thank you so much for joining us today. You joined us yesterday, the day before that, and the day before that. Things are getting worse.
They are. We seem to have reached quite an impasse here, to the extent that they decided to give up on July's meeting, and at the moment it's not clear whether they'll actually have any substantive talks for another month or so under the current structure. They're due to meet in early August. So I think the word to use is stalemate, but something perhaps has got to give. The current situation is sending oil prices higher. We've just seen in the last few minutes that in the US, oil prices are now at the highest since 2014. And we had an intervention from the White House last night who really called on the capitals involved to compromise and said that the Biden administration was engaging with concerned parties.
But, well, a higher oil price to the extent where actually it scuppers a recovery is in no one's interest. So is there still a chance that the two sides, and is it really OPEC, you know, on one side, except for the UAE on the other?
It seems like that. I think there are 3 main players here, Saudi Arabia and UAE, obviously, but also Russia. Not having an increase will really hurt Russia, and Russia will be pushing hard to broker some kind of compromise, because Russia went into this meeting very keen to increase output. They're not quite like the Middle East states where they can just ramp up oil and output immediately. They need to take time. They need to be able to plan. And this kind of situation makes it impossible for Russia to do that. So they will be pushing a resolution. But among the two protagonists, Saudi Arabia and UAE, the positions are really very dug in. And the key to the next few days will be watching to see how they react. Will the UAE do something to push the situation forward, perhaps by increasing production a little bit? Those are the kind of things we need to be watching.
Well, what kind of, I mean, I know we've been speaking and, you know, hitting the phone, speaking to traders. What's the oil price range that we could see? Could it go to 100, or would that be something that actually won't happen for at least a couple of weeks?
If we look inside the guts of the oil market at the spreads between different contracts, we're seeing that oil in the short term and through the third quarter of this year is really in demand right now. People are putting a premium on oil you can deliver in the short term, and that shows that the market's screaming for oil. And I think short-term prices could go quickly higher from here, but there's a difference perhaps between the short term and the slightly more medium term 2022, when there's a risk of more oversupply, especially if this UAE oil comes into the market as Abu Dhabi wants. So there are different risks on different time frames, but in the short term, yes, prices are going higher, and I think a lot of people think they could go higher still.
Well, thanks so much. Will Kennedy there, Executive Editor for Energy and Commodities. Now, we're also getting a pre-market for Didi. Yesterday, remember, we talked about Didi quite a lot. We'll get a lot more on the story in 10 minutes with our Sofia Horta y Costa in Hong Kong. Now, the ramifications of China actually cracking down on Didi, remember it IPO'd in New York a short while ago, has, of course, implications for U.S. investors. So Didi pre-market, you can see down 25% out of the news in the last 72 hours. Coming up, ECB officials gather for its biggest strategy review in almost 2 decades. A key issue at stake is agreeing to a new formulation of the inflation target. So we'll get more on that next. And this is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. England plans to lift all COVID restrictions, including social distancing and venue capacity limits, from July the 19th. Face masks will be voluntary and the government will no longer instruct people to work from home. Prime Minister Boris Johnson says cases will continue to rise, but people must learn to live with the virus and exercise judgment to protect themselves.
We must be honest with ourselves that if we can't reopen our society in the next few weeks, when we will be helped by the arrival of summer and by the school holidays, then we must ask ourselves, when will we be able to return to normal?
Now, the leaders of Germany and France are urging China to allow more flights from Europe as one way to strengthen political and economic ties. The three-way video summit also discussed cooperation in Africa and global vaccine supply. An official said the leaders agreed there was a window of opportunity to revive the Iran nuclear deal. And Japan will reportedly hold the opening ceremony of the Tokyo Olympics without any fans, giving up on earlier plans for spectators at the July the 23rd event. The Asahi newspaper says IOC members, sponsors and other officials will indeed attend, but efforts are being made to downsize numbers. Venues with a capacity of 10,000 people or more will also be banned from having spectators or games after 9 p.m. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg Francine.
Leanne, thank you so much. Now, the ECB's top policymakers are gathering this week for its biggest strategy review in almost 2 decades. A key focus is agreeing to a new formulation of the ECB's inflation target. Now, the central bank's role in fighting climate change, as well as how to address an ever-evolving labor market, will also be high on the agenda. Well, joining us now is Peter Shafrick, global macro strategist at RBC Capital Markets. Peter, as always, thank you so much for joining us. What exactly are you expecting from the ECB? So we think that there will be some, maybe asymmetric look at inflation. What would be the right way of looking at it?
Well, first of all, as you said, there's a whole laundry list of things that they're looking at, ranging from plain old monetary policy things such as what is inflation to things that haven't been previously included, such as you just mentioned, green elements and what have you. If we zoom in on sort of the things that are probably the most impactful for the markets, I would probably say there's one, what actually is the definition of inflation, and there's a lot of debate about whether or not that should potentially include owner-occupied housing. So that's basically a measure of how much does it cost and how does the prices develop for owning and maintaining your own home. And that hasn't been previously included. And that's probably going to lift inflation a little bit, not massively, but a little bit, but it's probably quite far out. And then the second element is really sort of what is their remit about what they're targeting. As you know, currently it's just under 2%, and that's likely going to change.
So, Peter, what are the market implications for all of those changes?
Well, the biggest change for markets that we think is likely going to happen is that when you look at that inflation remit, first of all, they're probably going to drop the just under 2%, but that's small beans compared to other things. And then the other big question is they currently have what they call a symmetrical target around that 2% handle, but they never really defined exactly what that symmetrical is supposed to be. And there's two rivaling definitions. One is that you should be just as aggressive if inflation is above the target as you are below the target, so you're symmetrical in your response. And the other one is symmetrical over time. So basically, if you are below the target or have been below the target for quite some time, you can be and shall be above the target for some time to iron sort of the differences out over time. So that's obviously much, much closer to an average inflation target. If they move to something like this, which I think is quite possible, what that means is if you run some modeling, it will take an awful amount of time until we iron out sort of the sub 2% inflation period that we just came through.
Peter, does it make sense, actually, the way you look at what the Fed is doing and what the U.S. is doing and what Europe is doing and also different dynamics in this region, would it make sense to look at it through that lens?
Well, I think that it does when you really sort of take 3-4 steps back and think about what do they want to achieve in the first place. And one of the biggest economic and societal elements that have been causing problems over the last decade, at the very least, is that you have a very strong imbalance, particularly on the wage earner side, with low income brackets not having benefited at all from the recent upswings and recoveries that we had after the last 2 crises. And I think one of the elements that shall be pursued is that you allow a longer period of time in a rebounding economy to allow wages to rise, to iron out some of these imbalances as well. And the central bank's contribution would be to allow that to happen without reacting immediately. Now, if that's the case, and particularly, again, if you go back to the modeling of Europe, it will take much, much longer in Europe before you get anywhere close to achieving an average inflation target. And if that's the case, in my mind, that also means that the short end of the European curve will be anchored probably until the middle of this decade.
Peter, let's also talk about OPEC Plus. There is a real danger that actually the price of oil goes up. How dangerous is that for the global recovery?
I mean, there's always with these natural resources, there's always a double-edged sword, of course, because on the one hand you have the producers who are going to benefit from it, and on the other hand you have the importers who have to pay the price for it, of course. So, I mean, for the US, it's probably less of a problem than it is for the European continent, because apart from sort of one or two, there's hardly any meaningful producer of oil and energy, oil and gas. And particularly for the continent of Europe, that's clearly a drawback. So it's probably adding to the price increases that we already had. And one of the things that sort of could be seen as a danger for also in the light of what we just discussed is if the current transitory elements, particularly of higher energy prices, turn out to be much, much longer in their transition period than we previously assumed, and therefore the high energy prices cause a higher overshoot of inflation, and that's typically a negative for generally for the economy. It's the wrong type of inflation, if you want. It's not the inflation that's been created through higher wages. It's an external effect.
Peter, I also want to ask about China because there are a number of stories that we're following. First of all, Didi and what that means for U.S. investors, but also future listings of Chinese tech companies in the U.S. The other underarching, of course, is defaults and what happens with some of the defaults. Will they be managed correctly by policymakers? And then, of course, we have questions on some of the PMIs that we saw that have been a little bit weaker than expected in China. Just a simple question. Are you worried about the direction in which China's taking, or do you think that they can still be, a source, I guess, of growth for the world?
I mean, there's multiple questions, of course. So let's for a second leave sort of the listing questions and the geopolitical element potentially aside. And if you just look at the current dynamics, there is, of course, a risk that the upward dynamic that we've seen coming out of China and probably the entire Southeast Asian region is lessening a bit. And if that's the case, particularly again, sort of if we bring it back to Europe, that's potentially a negative for us over here in Europe, because as we have discussed many times before, we're very open economies, and we generally benefit when the rest of the world is doing well, indeed. So that could be a drawback. But for the time being, I think these negative cyclical elements, they are relatively contained. So let's leave it there. As far as the geopolitical element is concerned, and the potential of making it much harder, for instance, for Chinese companies to list in the US or somewhere else, and all these type of things. I mean, in my mind, those are questions that go to the heart of how we currently do things, how we operate on a global scale, how companies sort their finances on the one hand, but also operate their production chains. And these are things that potentially have quite large ramifications, but the time period is much, much longer. I would think like 5 to 10 years. So there's nothing that sort of affects us in the immediate time frame.
All right, Peter, thanks so much. Peter Shafrick, also with really the best background in the business. Do we pay you royalty to have the Bloomberg terminal? Well done, Peter. Peter Shafrick, global macro strategist at RBC Capital Markets. Now, coming up, as China continues its crackdown on big tech, ride-hailing firm Didi remains firmly in the crosshairs. So the company is now banned from Chinese app platforms. Does this actually hail the beginning of a new normal for Chinese tech firms? We'll discuss that next. This is Bloomberg.
asleep. So stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at some of the events we're watching today. At 10 a.m. London time, we get Eurozone retail sales recorded in May. The data is expected to show an increase of more than 4% over the previous month. Now, Germany's ZEW survey will be out at the same time. It will report the latest outlook for the German economy. And as you've heard, ECB policymakers will hold a special meeting in a bid to complete the strategy review. And finally, the annual Sun Valley Conference is set to return after being canceled during the pandemic. Mark Zuckerberg, Warren Buffett, Jeff Bezos are expected as what's known as a summer camp for moguls. Now, China's ride-hailing giant Didi is the latest tech firm to be brought to heel by Beijing. Despite listing in a blockbuster U.S. IPO last week, yesterday saw the app banned from Chinese platforms. Now, the move underscores the Chinese government's commitment to controlling the 21st century's most valuable resource, its data. Joining us now, Sofia Ortay-Costa. She is Bloomberg's China reporter in Hong Kong. Sofia, thank you so much for joining us. So why is Didi actually being targeted by Beijing, and what do we know about the Chinese motivations?
Good morning, Francine. So Didi down as much as 28% in U.S. pre-market trading. Obviously, U.S. markets were closed yesterday, so you see the big reaction to this news. So Didi, as you say, it's a ride-hailing company, but most importantly, it's used by 500 million. It has a 500 million annual regular users, and that is just the majority of them being in China. That is just a huge amount of data, extremely sensitive data that the Chinese government does not want to hand over to U.S. investors, and that is what we're hearing is the main motivation for this kind of regulatory clampdown on Didi specifically. But obviously, looking back and more broadly at Chinese tech in general, a lot of these mega cap Chinese firms that are looking to list in New York, or at least selling shares outside mainland China, a lot of them have access to troves and troves of data. That was the problem, of course, also with Ant Group, the the fintech giant that did not list in November because Beijing, told that company that it had concerns over the influence that it had over the financial system, Francine.
So, Sophia, who exactly are the biggest losers here?
U.S. investors, the fact that China decided to announce this 2 days after the IPO, or announce that it was reviewing the company, and then only 3 days later that it was banning the app from app stores. It is, quite telling that they did this after the IPO had already started trading. U.S. investors, seeing obviously significant losses. We'll see that today. But also Chinese companies that are looking to raise funds. Remember, these companies are significant. They make a lot of losses. They need the cash to grow. They need the cash to expand their businesses, looking for overseas expansion as well. Where are they going to get that funding? That pipeline is going to look really, really difficult now for NYSE and NASDAQ listings. Francine.
So, Sophia, what exactly does it mean that Chinese firms don't want to list in the U.S. anymore until they get like a green light from, Beijing, or is it U.S. investors that don't want to buy into it until they get some kind of clarity on what's going on?
Yeah. Exactly. I think it's a twofold dynamic here. Chinese companies will always want to list in the U.S. We saw, a huge amount of activity this year, even though, as you remember, Francine, in March, the SEC, the securities regulator in the U.S., came out with a very stringent rules that began during the Trump administration and are getting tougher under Biden. That makes it more difficult for Chinese companies to sell their shares to U.S. investors, and also for existing Chinese companies already trading in the U.S. To be a part of, portfolios in the US. So the environment is already difficult, but companies will always look to the US for listing. That's where the biggest capital market is, right?
Thank you so much. We'll have plenty more on Didi throughout the day. Sofia Acosta. Coming up, we'll also talk about COVID.
G7 today need to wake up and listen to the science. There isn't room for discussion on this. Scientific inevitability, and they need to act. They don't need to talk anymore. They need to just act.
Climate change has been on the agenda of the G7 since maybe 2003. So we need to see action, not just talk. And we've only got 9 years left to halve carbon emissions if we're going to stop dangerous climate change happening.
United, we'll never be defeated! The world is possible!
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
OPEC talks break down the conflict between Saudi Arabia and the UAE, blocks the cartel from agreeing an oil supply increase. WTI crude hits its highest since 2014. The English experiment. Boris Johnson says England will end social distancing, capacity curbs, and work from home guidance on July 19th. And the ECB enters its final stretch of its biggest strategy review in 2 decades, with climate change and the labor market on the agenda. Well, Bloomberg learns talks may culminate in an announcement this week. Good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on Tuesday, the 6th of July. Some of us are also a little bit distracted by the football, the Euro football game happening later this evening, Spain versus Italy, 8 p.m. UK time. On to other matters, though. Boris Johnson has announced plans to end social distancing in England from July the 19th. Face masks will be made voluntary, and the government will no longer instruct people to work from home despite a surge in infections.
We're seeing cases rise fairly rapidly. There could be 50,000 cases detected per day by the 19th. And again, as we predicted, we're seeing rising hospital admissions. And we must reconcile ourselves, sadly, to more deaths from COVID. We have to balance the risks. The risks of the disease, which the vaccines have reduced, but very far from eliminated, and the risks of continuing with legally enforced restrictions that inevitably take their toll on people's lives and livelihoods on people's health and mental health. And we must be honest with ourselves that if we can't reopen our society in the next few weeks, when we will be helped by the arrival of summer and by the school holidays, then we must ask ourselves, when will we be able to return to normal? We will change the basic tools that we have used to control human behavior. We'll move away from legal restrictions and allow people to make their own informed decisions about how to manage the virus.
Well, joining us now is Sam Fazeli, who leads our pharma coverage for Bloomberg Intelligence. Sam has been really a beacon of wisdom. And Sam, you help us understand exactly some of the right decisions, some of the wrong decisions, and how we should think about it. So, look, after the announcement of Boris Johnson yesterday, a lot of people, are relieved that finally we're getting back to some normality. Others question, why are we not wearing masks if in other countries you still wear masks, despite the vaccination uptake? So how do you see this?
Yeah, good morning, Francine. So I'm halfway between the agree and disagree camp. I agree that at some point we just have to bite the bullet and get on with this, because there could be yet another variant around the corner, and whatever. It's just been a very unpredictable pandemic that we've been dealing with. So, but on the other hand, I don't understand where the return to normality and freedoms, how that's impacted by still asking people to wear a mask on crowded places, in crowded places. Of course, you can't have that and go to a nightclub. You can't imagine people will wear a mask. So maybe this is a pragmatic decision, but I don't get that either. Why would we need to revive all those things for an economic revival and not wait another 2 months for those little aspects until full vaccinations of adults have hit the 90% range?
Sam, what's the right way of actually looking at this, though? So do you look at, what do we know about the vaccinations? Do we finally know whether you can still transmit if you're vaccinated, or whether it actually stops the transmission?
Oh, no, you can still. It's all about reductions in probabilities. You can still transmit the virus if you're fully vaccinated. In fact, there's more and more stories like that. And so you're not going to get rid of transmission. You're just reducing the risk of it. So, and the vaccination rates are going up quite nicely in the UK. I predict that by 19th we'll be close to 70% fully vaccinated and close to 90% people with adults with 1 dose. But of course, there's the 12 to 18-year-olds that we have to consider. So why don't we put them in the equation?
Yeah, and I think I was looking at figures. There were like 375,000 kids that were isolating because of COVID-related, because they've been exposed, basically, of students, right, of kids, I think between the age and 5 and 18. So do we need to get everyone vaccinated, including small children, to make sure that we get rid of this?
Yeah, I think your phrase, to get rid of this, I think we have to forget about that. We're not going to get rid of it. To reduce the risks further and further, I think certainly we need to think about the adolescent group. The younger children is a bit tougher to think about, but if we can get the adolescents at least, where we have data that the vaccines work and they're relatively safe, then we should get those done too, and I'm surprised the government isn't talking about that.
Sam, I think we saw in Israel a mandate to, not having to wear masks, and then they had to go back to masks. Is mask wearing effective? I know there were also a couple of questions on plexiglass and whether that's efficient. Like, how much are we wiser about what works and doesn't work to contain it, like 3-4 months ago?
Yeah, no, I don't think, Francine, much has changed about the efficacy of the effectiveness of masks, especially if two people are wearing it. Remember, the idea is that a good mask, and I stress, a good mask probably gives you a 20% increase. I'm plucking a number out of thin air. I can't remember exactly what it was, but it was in those ranges, 10 to 20%, 30% risk of you acquiring a virus. And then if you were infected, it significantly reduces your risk to other people. So when you combine the two, with really good masks, you can get up to about the 90% level. Now, those studies were done with other versions of the virus. Now, with this variant, maybe that's come down a bit. But still, if you layer that on top of what vaccination gives you, that's pretty high protection if we had just kept the masks. And I don't understand why it's gone.
Sam, so one of the other things that that we struggle to understand is exactly what's happening with travel. So, for example, I'm trying to get to the G20 in Venice this weekend, which means, isolating almost on both ends. It means, about 5-6 tests to then test and release back in the UK. But then from July 19th, I'd be able to walk in the street, go into a museum without a mask.
Yeah, but traveling, it looks like we're going in the direction of at least allowing the vaccinated folks, fully vaccinated folks, to travel without the need to quarantine on either end. Even Germany has just dropped its requirement for British people and Indian and Portuguese from having to quarantine if they're fully vaccinated. So if the UK does the same, then that aspect of our lives gets a bit easier. How long that lasts, Francine, I don't know. It all depends on how countries get worried about infection rates, etc. But currently it seems to be that within a couple of weeks, I wish your G20 was earlier, we'll be able to do this without isolating either end.
Sam, thanks so much. Sam Fazali there from Bloomberg Intelligence, of course, on COVID-19 and some of the variants. Now, coming up, FinTech and the City, the former chief executive of Barclays joins this program to talk about his latest venture and how the digital banking landscape is shaping up in the UK. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Buyout firm Bridgepoint Group has confirmed it's going ahead with a London IPO. It has filed its intention to float document after announcing last week it aims to list at least a quarter of its shares to raise about £300 million. The UK private equity company invests in middle market firms across Europe. It has stakes in Burger King franchises and in Itsu, the Asia-inspired food company. Now, Ocado has signed an agreement with Auchan to develop the retail retailers Alcampo online business in Spain. The companies will initially build a customer fulfillment center to serve the Madrid region starting in 2024. Separately, Ocado has reported EBITDA for the first half ahead of the average analyst estimate. Credit Suisse says it is planning to introduce a work model that gives its employees in Switzerland maximum flexibility. Approximately 13,000 staff will be able to decide with their teams and managers how much of their time they want to spend outside and inside of the office. The bank says policy for the rest of the 49,000 global employees will be determined by local guidelines. And Xiaomi is planning its first green bond as part of a broader package of dollar-denominated debt, adding to a surge of green securities from Chinese issuers. Bloomberg understands a smartphone maker has hired banks to arrange fixed-income investor calls today for the proposed bond offering. The company has seen a surge in phone shipments ahead of other big global producers. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, London's digital banking scene is growing. 10x Future Technologies, founded by former Barclays chief executive Anthony Jenkins, is a fintech firm helping established banks make the transition to digital. And in the last month, it has raised almost $200 million in its Series C funding round. Now, it's being backed by investment heavyweights BlackRock, JP Morgan, and Canada Pension Plan Investments. Well, I'm delighted to be joined by Anthony Jenkins. He's founder of 10x Future Technologies. Anthony, thank you so much. I thought we caught up actually earlier than we had, so it's a wonderful update to see how you've lived through the pandemic. And actually, when you look at where banks are today, after many years at Barclays and in big banks, what have you learned about the difference between big bank and fintech?
Yeah, I mean, one of the things about COVID is it's massively accelerated digital adoption in all areas of our lives. I mean, look how we're conducting this interview. And I think what that's done is increase the imperative for big banks to go digital. And that doesn't just mean making an app. What it means is making a great user experience, which really adds value to their customers' lives. Simplicity, speed, economy in terms of pricing, those things are really important. And I think what's happened in the fintech sector over the last 5 years is fintechs have demonstrated that those user experiences can be built. And the imperative now for the larger banks is to do the same thing.
So what are your plans for the company? You've raised some $187 million, I think, in June. What are your expansion plans? Are there new markets or new technologies that you want to get into?
Yeah, I mean, we're incredibly excited at 10x. It's been almost 5 years. We're celebrating our 5th birthday this year. I can't believe it's been 5 years. But up to this point, we've been focused on really honing the technology and making sure the technology delivers that 10x promise. We're working with 4 clients currently. 3 of them are live at the moment. And by the end of the year, 2 of them will be live at scale. That's very exciting. But our big objective now is to scale the business, add 10, 20, 30, 40 clients globally. We're targeting particularly North America and Europe, but also we have a footprint in Australia, so Asia is very interesting to us. So we are really at that point now of massively scaling the business. That's what we raised the Series C for, and we're incredibly happy to have the high-quality investors that we've got in the business.
Anthony, there's a FinTech Wise, which is going public by direct listing tomorrow. Is it something that you would, look for 10x?
Yeah, I certainly wouldn't rule out an IPO. As somebody who's been the CEO of a publicly traded company, I know the pros and cons of that very well. But I think if it was right for the company at some point, we would certainly contemplate it seriously. I don't think that's in the next 1 to 2 years, but it could certainly be in the next 3, 5, 7 years' time.
And what do you make of the proposed rewrite of the UK listing rules? Do you think it will attract more fintech companies to London?
Yeah, I think it's hard to say. I mean, our culture around publicly traded companies and the balance between the rights of shareholders, founders, and management is different to the US experience. So I think the proposals are good proposals, but I think it's uncertain as to whether it's going to really shift that balance of listing towards the UK. The UK has many attractions as a listing venue. As you mentioned, a huge fintech is about to IPO on the market. So it's a good place for us to be in the UK, but I think it's always appropriate to consider whether there are modifications that could be made that might help us become even more attractive.
Anthony, overall, how are you approaching working from home or, return to the office? So do you want people back in the office? Do you think it's a good recruitment tool if you're more flexible compared to some of the big banks?
Yeah, I mean, we are a global company, so we have people on the ground in Australia, we have people working for us in India, obviously the UK, and so we've been dealing with this at the global level, not just the national level here in the UK. Our position has always been to put the safety of our colleagues first, and so we went to remote working sooner than the government recommended in this country. I think we've proved that we could be productive and effective working remotely, but we've also learned that when you need to be creative and collaborate, there's nothing like being there in person. Our office is open for a modest number of folks to be in, and in fact, I've got my leadership team in a COVID-safe way this afternoon to go through some strategic matters for us. So, I think what we will do at 10X is gradually bring folks back in waves, depending on their work requirements. But I would expect us to go into a hybrid working model. I think we can make that work in 10X, and I think it's also important to provide flexibility to our colleagues.
Anthony, we also talked about, you clearly said that you want to expand and actually, get bigger at this point. How much bigger do you think 10X will be in the next 12 months?
Yeah, I'd see this journey as being the next sort of 12 to 36 months. I would see us adding somewhere between 5 and 15 clients over that time period. And, once we get to there, we'll be a sizable SaaS-based technology company, and back to your earlier point about IPOs and so on, I think an attractive candidate for the market. So, there's a lot of work to do, but we're incredibly well positioned in a category that is literally expanding at the speed of light as banks grapple with all of the digital challenges that we talked about at the start of the interview.
And if the IPO is I think you said 1 or 2 years away, or that you'd certainly be thinking about it, is it given that it's in London, or what's your thinking on that? What are the parameters that you'd be looking at?
Yeah, to be clear, we would contemplate an IPO not before that time period. And London is a very attractive market. It's our home market. I think it is friendly for companies like ours. There's a great ecosystem of support around us here. It's a highly respected market internationally, as you can tell by our private market investors, both international firms. So, I think London would be right at the top of my list if and when we contemplate an IPO.
Anthony, thank you so much. As always, Anthony Jenkins, their founder of 10X Future Technologies. Now, coming up, WTI crude rises to the highest level in more than 6 years after OPEC Plus failed to agree on a production increase. So that story is up next. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold in economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a lot of the market focus will, of course, be on what the ECB has said, will say. A lot of the focus is on oil. Our Will Kennedy was bringing us up to date on the spats. That's just escalating. There is also a question whether the UAE could actually leave OPEC+. I don't know whether that will become a reality. And then our other stories, of course, Didi slumping after the Chinese regulator orders stores to remove that from the app, down some 25%. So let's get straight to crisis mode for OPEC. Let's talk markets with Bloomberg's Eddie van der Velde. Eddie, if the Saudis hold firm and there's an oil price spike, could that actually force central bankers to turn more hawkish sooner? I mean, is this now a reality compared to yesterday was more speculation?
Yeah, I was really interested to listen to Will earlier, because this is exactly the problem for central bankers, is that oil prices are feeding through into inflation and forcing their hand perhaps on raising rates sooner than they would like to. I mean, central bankers would like to sit tight a little bit, I think, with rates where they are, and see, you know, employment levels rise further before they start, you know, pinching off the recovery. But I think this is a difficult situation for them, because typically an oil price spike is something that is seen as transitory. But if you see oil prices continually drifting higher, and it feeds through into supply chains, and it feeds through into shipping costs, then it no longer is transitory. And that is the point at which the central bankers have to act. And I think this is difficult, and that's why I think we're seeing this reverberate across markets.
How, I mean, what does that mean for dollar, for example? Are the most expensive commodities playing a role in weighing on the dollar?
Yeah, you know, I think just today when I look at it, so we had the Aussie and the Kiwi up, both you know, on idiosyncratic factors there. But at the same time, I think what's happening here is that oil is rising, metals are rising. That's supporting commodity currencies, and that's just helping to add a little bit of weight to the dollar this morning. Now the dollar, I think is stabilized a little bit, not as bad as it was in Asia in Asian hours. So things have settled down a little bit. But I think if this spat at OPEC blows up, I think the next few days could be very interesting in markets indeed.
Eddie, how much are you looking at the ECB? So we're expecting a review. We could have the findings as soon as this week. Are you expecting a lot of change, or, you know, what kind of impact could it have on the markets?
Yeah, the ECB is an interesting one. The ECB traditionally has lagged in terms of, you know, changing policy. It was certainly behind the curve in the previous tightening cycle, and pretty much got left behind as a result of the euro crisis and so on. But I think you know, the ECB this time, particularly European banks, have struggled to get on the front foot because their rates have just been so low. The ECB would very much like to get on the front foot, but I don't think that they're in a position to do so. The recovery is not as strong as it is in Europe. Now we're starting to see PMIs coming through in Europe that are really spectacular. You know, every month we're seeing readings of 60 or thereabouts. If that continues and if inflation picks up, I think the ECB would like to start raising rates, but I don't think they're anywhere near it yet.
All right, Eddie, thank you so much. Eddie van der Velde there from our MLive team. We'll have plenty more, of course, on the markets today. A big OPEC day, because we need to look at exactly what's happening with the price of oil. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. K-Line is actually off for the week, so we'll be joined by Danny Berger here in London with me. The markets, so we'll look at treasuries. We'll look at what exactly is happening in oil. The other big story, of course, that we're watching today, I don't know if we have the market board. If we do, it'd be great to get it up, so we also look at Didi slumping in pre-market after the Chinese regulators ordered the stores to remove the app. Now, the other thing I'm looking at, of course, is oil. We'll have full coverage of OPEC Plus with our Will Kennedy. That will be in just a couple of minutes. Oil jumping to the highest in more than 6 years after this bitter fight between Saudi Arabia and the United Arab Emirates plunged once again OPEC Plus into a crisis, blocking a supply increase. We'll have a full roundup of our top news stories ahead. This is Bloomberg.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We must be honest with ourselves that if we can't reopen our society in the next few weeks, then we must ask ourselves, when will we be able to return to normal?
So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives. It no longer paralyzes our nation.
We're no longer looking over a cliff, but instead we're transitioning from recovery to expansion.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
10 10 a.m. here in London, 11 a.m. Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, July the 6th. Our top stories today. OPEC Plus fight rocks the oil market while crude rises to a 6-year high after infighting prevents a deal to increase productions. China strikes back while Beijing's crackdown on big tech puts dozens of U.S. IPOs at risk. And new worries for British business: COVID restrictions are being relaxed, but some companies are concerned about being held liable if infections rise in the workplace. Well, good morning, everyone. I'm Francine Lacqua with Matt Miller and Danny Berger. Kaylee Lyons is off this week. Now, Matt, there's quite a lot going on in the markets because of OPEC. They're fighting. It's getting worse, and actually it's driving the price of oil higher.
Yeah, I find it absolutely fascinating, though. There's so much involved in this. The UAE apparently feels it can pump a lot more oil than it's allowed to right now. Plus, they want to prepare for an oil-free future. And in order to do that, they've invested a lot of money and they want to reap the benefits. So they kind of want to reset the relationship. That's something the Saudis don't want to allow, because then maybe everybody is going to want to reset the relationship, and it could be chaos, dogs and cats living together. You know how that goes. Let's take a look at what's going on in the Asian markets here. You can see that we have kind of a mixed trade, at least, but it looks a little bit better when you look down into Southeast Asia. One huge exception is Vietnam. The Vietnam index is falling now more than 3 standard deviations away from its average 30-day Z-score. I know that from looking at the GMM. You can see here down 4%. We're hearing reports there that it's profit-taking, which I know as a former stocks reporter, that's what you say when you don't really know why it's falling.
Yeah. That's exactly what you say.
Nonetheless, I mean, maybe, you know, it has to be partially profit-taking, but it could be fear as well. People are selling. Yeah. It's not wrong. You're right. It's not wrong. Rice futures, I just thought was interesting. You know, Tom Keene years ago turns me on to the importance of rice as a staple food for a massive portion of the world. It's incredibly important. And I think sometimes the West loses sight of that importance. Right now, it's getting a lot cheaper, which is good news for people who need to buy rice. And then the Aussie dollar, I put that in for the RBA. Danny's really excited about the RBA, more so than I am, but we could see a shift in, Danny, isn't this right? We could see a shift in their monthly asset purchases, which are, you know, millions of dollars worth of asset purchases every month.
Okay, but it matters, Matt, because it means that they're dialing back some of the QE, right? I don't care if it's millions, if it's hundreds, it's a change, right? And we care about shifts here. Matt, I also wanted to flag news coming out of there in Germany, the ZEW, if you want. German index. I know I'm getting pretty European these days. Coming in weaker than expected in 63. The estimate was 75. This is just the latest data we've gotten out of Germany this morning that's looking weaker. We also had industrial numbers, which disappointed as well. You can see the DAX falling 0.4% over here. A lot of that is data as well. Elsewhere, the only place you're really going to find green in Europe is in Eastern Europe. Elsewhere, I mean, we have unchanged in the FTSE 100. France is weaker, Spain is weaker. So not exactly a bright picture, but not a horrible one either. So that means the main stock 600 benchmark index, rather, flirting with moving lower today. But I want to get into what some of is moving that, because the news coming out of the UK making a difference here, with Boris Johnson saying, hey, we're going to relax some of the social distancing, if not all of it, giving you an option whether to wear a mask or not. Right. And so that means that we see a stronger pound ever so slightly.
I'm really surprised. I mean, the Germany factory orders, I don't know whether it points to like a two-pronged, you know, German economy, or what the concern is out there, because it's basically supply chains, right? We're back to kind of square one in trade, and we're not exactly sure when we'll get back on track.
Right, exactly. The fact that this is a confidence indicator is really essential here, because you can have factory orders, which was the data we had earlier giving us the numbers, but how people actually feel is really crucial to how they're going to stockpile, the money they're going to spend. That's really important, isn't it?
Yeah, it certainly is. What else are we watching? So I know we're looking at pound because we're reopening. We're reopening on July 19th, and apparently we don't have to wear a mask
for now.
anymore.
Don't have to wear a mask for now. It's up to you. If you're in a crowded tube and you want to wear one, you can. Travel and leisure also doing well because of possible flight. We're also looking at crude, NYMEX crude at its highest since 2014. And really, I put a lot of stuff on the board here that's probably driven by that. Higher yields. Is inflation going to be a concern? Is that what oil is driving today? Is it waking up the bond market? So we're seeing small cap do a little bit better, cyclical rotation perhaps. NASDAQ futures lower. This could just be, again, a rotation, or it could be the effects of China cracking down on U.S.-listed Chinese companies, Francine. If you're an investor here, you probably are concerned about the headlines over the weekend.
Yeah, I mean, if you're an investor, you probably don't want to play into some of these companies. If you're a Chinese U.S. company, I mean, you're a Chinese company, a tech company, you probably don't want to list in the U.S. until you understand the rules coming out of Beijing. Now, this is what else we're looking at today, Danny. ECB policymakers holding a special meeting in a bid to complete its biggest strategy review in almost 2 decades. We're expecting an update on the New York City Democratic primary as absentee ballots come in. And finally, the annual Sun Valley Conference is set to return after being canceled during the pandemic. Mark Zuckerberg, Warren Buffett, Jeff Bezos are expected at what's known as a summer camp for Mongols. Do you remember when we used to play that game, Matt, who you'd invite for dinner for your perfect dinner party? I don't know whether Sun Valley's one of them, but maybe it makes the Matt Miller list of invitees.
I don't think they'd be on my list. Nope.
Okay, we'll talk about Matt's list shortly. OPEC Plus, though, in crisis amid worsening infighting. The alliance called off talks yesterday as the bitter argument between Saudi Arabia and the UAE blocked a supply increase. Brent crude rose to its highest level since November 2014. So let's get more from our Bloomberg executive editor for energy and commodities, Will Kennedy. Will, is there any turning back, or actually now we're not going to have a deal and the price of oil just shoots up?
Well, I mean, the oil prices reacted sharply to yesterday's news, as you say, Francine. In New York, we're back at the highest since 2014, and that's going to be an issue for the White House because people are starting their summer driving season and paying more than well over $3 a gallon for their gasoline. And that's why I think we saw some quite strong words from the White House last night looking for a compromise. Where that compromise comes from, though, is difficult to see. Both sides are dug in. Russia isn't happy, but unless UAE and Saudi Arabia get talking again, it's hard to see how this gets resolved anytime soon. In the meantime, there's no scheduled meeting until August. The market's not going to get the barrels it wanted in August. It's going to have to wait till September, and that's why we're seeing prices shoot higher this morning.
If I could pay $3, if I could get a gallon of gasoline for $3, I would back up the truck because I'm paying twice that here. I just want to make that clear. And I do drive a truck. One thing I'm looking at, Will, is the forward curve. And of course, we're looking at prices that get lower and lower and lower the further ahead, the further out you go. I wonder what this means in terms of investors thinking maybe OPEC members will be non-compliant in the future. Maybe OPEC members will disagree more and more as we go forward. If they break away and decide to sell as much oil as they want, what does this curve look like?
Yeah, no, I think the curve is telling an important story, as you say, Matt. In the short term, it's screaming for oil. So you're seeing prices at the front of that curve move sharply higher, saying, you know, in the next few months, you know, we're pricing to draw down inventories really, really hard because the market's not supplying what we need. But next year looks a bit more uncertain. As you say, for the reasons you say, you know, the UAE seems determined to produce more oil come what may, and, you know, we don't know how that will happen through a deal or through a rupture, but it will probably happen. Iranian oil is likely to come back into the market if we can get a deal at those talks in Vienna. And the other thing putting pressure on the back of the curve is if you're a shale producer right now and you see this curve moving upwards, you could lock in for next year, and I think there's some selling pressure there. So it's a short-term bullish, but the longer-term price outlook, as you say, Matt, is a lot more uncertain.
Well, thank you very much. That's Bloomberg Executive Editor for Energy and Commodities, Will Kennedy. Now, Chinese companies hoping to list in the U.S. may now find it harder to pitch their shares to prospective investors. This, of course, is China cracks down on ride-hailing giant Didi and other technology firms that have recently listed in New York. Let's get more on this with Sofia Horta y Costa, Bloomberg's chief China market correspondent in Hong Kong. Sofia, do we have any idea of to what extent Didi was communicating these risks with shareholders? Was this present, or was this a surprise when we learned of the crackdown over the weekend?
Well, as you can see with the share reaction today, the stock down as much as 28% in pre-market trading. It was definitely a surprise for investors who bought into the IPO. And let's not forget, Didi is not a small company. Its IPO was $4.4 billion US. This is the second biggest IPO of a Chinese company in New York since Alibaba in 2014. And what we're hearing from talking to people here is that the Chinese regulators were talking to Didi at least 3 months before its IPO, saying, delay the IPO. We have concerns over the data, the security of your data. So Didi did know that there was a review going on. It went ahead because it wasn't actually in breach of any rules.
So, Sophia, when do we have clarity, right, from Beijing what exactly they want? If you're a U.S. investor, you don't want to get into a Chinese company. If you're a Chinese company, you probably don't want to list at the moment.
Yeah, exactly. New York is a very attractive place for Chinese companies to list. There is a very deep pool of capital there. Valuations are much higher. And if you just look at the performance of U.S. stock markets, they do so much better than China or Hong Kong. But for, the concern for Beijing is that it doesn't have rules in place. It needs more time. There isn't a regulatory framework. This new rule, cybersecurity rules, the body only really came into effect a year ago. So this is all very new for China. It doesn't really know what to do with the vast amounts of data that these private companies control. And if these companies are then selling shares to investors, they're in the hands of foreign international investors. That is another problem for Beijing. It just needs more time to figure out how it can control, these things that are very important for national security in China.
Right, well, if it's going to take more time, we'll see how much further the prices will fall then as they figure it out. Sophia, thank you so much. That's Bloomberg's Sophia Orta y Costa in Hong Kong. And with that in mind, let's get a check on some of where these Chinese U.S.-listed companies are trading. Didi, as we've been discussing, falling 21%. Just want to flag it IPO'd at $14, so very much so below its IPO price. Now, another company that's getting caught up in the probe as well is Full Truck Alliance. We don't have as many details as what they're looking at here, stopping new registrations, much like Didi, for this truck hailing app. That one is down 15%. This one IPO'd at $19. So yet again, another IPO in the U.S. from a Chinese company below its debut price. This one IPO'd about 2 weeks ago. Finally, Alibaba, a bit weaker so far this morning. Of course, it's not one of the companies that China has specifically been targeting with this probe. In the past, they've been targeted for antitrust concerns, but all of this China-U.S. listed tech space at the moment in this morning's session pre-market is certainly under pressure, with investors asking, does this mean that we're about to have a restart, Francine, of the concerns of China cracking down? Is this the next leg that could, again, affect a company like Alibaba?
Yeah, it could. So all eyes, of course, on some of these big tech companies. Coming up, we'll talk China, we'll talk ECB, we'll talk oil prices with Trevor Greetham, Royal London head of multi-asset. And then a little bit later on, we'll also talk about inflation targeting by Madame Lagarde with Ludovic Subran, his Allianz chief economist. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Francine Lacroix and Danny Berger. Kaylee Lines is off today. Now, we're very much focused on the price of oil, which continues to rise. That's good for oil producers, and they're heavy on the FTSE. Right now, the FTSE is fairly cheap because earnings expectations keep rising as well. If we look at the forward PE ratio. I want to bring in Trevor Greetham to talk about this from Royal London Asset Management. He is the head of multi-asset there. And Trevor, you know, a lot of talk lately about UK stocks and their valuations and whether they're a buy right now. I want to get your take.
Well, our tactical models are actually pretty neutral UK, but there's got to be a big catch-up trade coming. So you quite rightly say the UK market's very heavy in the resource sectors, so the big oil majors, but also mining. It's also big in financials that tend to do better when interest rates rise. And it's got big sectors which have been lockdown victims in the UK, consumer-facing sectors in particular. So we think the UK is going to be a really great market over the next year or two. We're not quite sure now is the moment, but I certainly wouldn't want to be short the UK versus other markets. My hunch is the outperformance of the UK will probably come when technology sectors have another derating session. So it might be a bear phase outperformer rather than a bull phase outperformer, if that makes sense.
But Trevor, what does this all do for dollar? So how much do commodities and also the price of oil, weigh on dollar further down the line?
The dollar's been a real puzzle to us, actually, this last year, because on the one hand, very often when you see a global recovery, particularly a synchronized global recovery with strong commodity prices, the dollar is weak, and you can rationalize that by portfolio flows out of the US, investing in other areas, for example, strong emerging market economies and therefore strong emerging market currencies. But this seems like a very different environment because you've got very big desynchronization around the world because of COVID hitting in different ways in different places. And you've got, much more stimulus in the US in terms of fiscal policy, making US rates look like they're going to go up much more rapidly than other countries, for example, in Europe, will be raising interest rates. And that argues for a strong dollar. So we waver between the two at the moment. We think at the moment, this is one of those really unusual times where you can see a strong dollar and strong commodities.
Trevor, we can tease that out just a little bit beyond the dollar. I was talking to Ron Smith of BCS this morning, who said that should we continue to see some issues in OPEC, we could get $100, $110 a barrel oil. In that sort of scenario, how does that change your asset allocation strategy? How does that change the inputs to your model? Should we see oil at triple digits?
It's a really good question. I mean, we have a framework we call the investment clock, and that looks at what's happening to growth and inflation cycles. And at the moment, we've been in the overheat stage, strong growth, rising inflation pressure for 10 consecutive months. And if the oil price keeps going higher, that keeps inflation rising. It's going to keep us in that overheat phase. And in terms of asset allocation, that says we should be overweight commodities, which we are in our multi-asset funds, and underweight government bonds. And I think the risk there is if you see this summer of strongly rising oil prices, the pressure will be upwards and upwards on the US 10-year Treasury yield. And I think that could be a problem for the highly rated technology sector. So that kind of outperformance of the UK, which tends to do better when inflation's rising, it's all kind of related really to this theme. And I would expect commodity prices to keep doing well because of the reopening going on in Northern Hemisphere developed economies, particularly as we work through COVID. But there's lots of uncertainty still. It's going to be very bumpy. We don't know, for example, if the UK's gamble on reopening is going to pay off, whether actually we'll all be retrenching again into the autumn. So plenty of volatility along the way.
Exactly what I wanted to ask about, Trevor. Are you hedged for another step backward? I mean, we're already hearing people complain about the UK reopening, and across Europe, there are concerns that the Delta variant could force lockdowns again.
Yeah, I mean, I liken it to the UK as a nation is failing to finish its course of antibiotics. We haven't yet got all of the adults double vaccinated. We haven't certainly started on children. We've got this virus that's doubling in terms of caseload every 9 days. Already 750,000 people in the UK have got it, according to the ONS. And we'll be up to 1 million, 2 million, maybe even 3 million people over the next few months. And
I think there's risk around sterling here that at some point, either there'll have to be a move back into restrictions. And Boris Johnson was very keen, actually, yesterday to backpedal on the irreversibility of these measures, or people may just take it into their own hands to socially distance again. So I think there's a big gamble there. Obviously, there's the other side of the coin as well, that if we work through this big wave of infections, we build up immunity, the NHS, the National Health Service copes, then the UK economy will be probably that much stronger at the end of it. So lots of two-way risk in sterling, but if anything, we're actually trimming exposure to a currency that we've been overweight all year.
Trevor, thank you so much. Trevor Greetham there, head of multi-asset at Royal London Asset Management. We'll have plenty more on the markets shortly. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix with Matt Miller and Danny Berger. Kaylee Lyons is off today. Now let's get straight to the Bloomberg. First word news, and the European Central Bank is entering the final stretch of its biggest strategy review in almost 2 decades. Officials are trying to hammer out key differences over monetary policy. A major issue is agreeing to a new formulation of the ECB's inflation targets. In Hong Kong, a U.S. lawyer has been jailed for a little more than 4 months over a fight with a plainclothes police officer. Samuel Bickett's scuffle took place at the height of a pro-democracy protest in 2019. He's a former compliance director at Bank of America Merrill Lynch. Now, coming up next, we'll talk a lot more about the economy. We'll talk about oil. We'll talk about inflation. We'll talk about the ECB review with Ludovic Subran, Allianz chief economist. This is Bloomberg.
A bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there. I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, those things you have to be mindful about that. But I think it's incredible what's been achieved so far. But there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackwith, Matt Miller, and Danny Berger. Kaylee Lyons is off this week. Now, a lot of the focus, Matt, is on, of course, it's on the inflation review, it's on the ECB and all of that. It's on Didi, but really it's all about OPEC and the fact that they're not finding a deal. Actually, it's escalating and getting worse.
Yeah, absolutely. I think, Didi was a fun story. And of course, there's a much bigger story on China. Bloomberg has been doing some incredible reporting and analysis into that. But for now, oil is front and center. What's going to happen in terms of compliance for OPEC? Is the UAE going to make a move here? Is everything going to get smoothed out? And where are prices going to go?
Yeah, the million-dollar question. Danny, how's it all playing out in the markets?
Well, I kind of feel like I don't even need to do a market check now because that's exactly what's happening. Everywhere else is really struggling for direction. It's only oil that has the clear move higher today. Well, we know WTI highest since 2014, Brent highest since 2018, up 0.3%, hovering just around $77 a barrel. During the Asian trading session, it looked like yields would move higher, that we had all this concern about inflation. I mean, they are barely moving now, not even a basis point. We have the dollar slightly higher as well, but that's only 8 basis points. And we do have a little bit of a weaker session when it comes to U.S. futures. I, for one, will be interested to see the first time in 7 days that the U.S. market has not hit an all-time high. Even if it's only a little bit down, that at least is something. Well, let's get a look on some of the pre-market movers. A big one is going to be anything energy related. This is the energy ETF, the iShares one of the biggest ones, up 1% so far pre-market. We've been talking about DD a lot. That is still down about 22%. Of course, scrutiny on China, a lot of these U.S. Chinese listed IPOs. And with that in mind, the last one I've included here is another one. It actually was up some 14% when the market first opened, but I guess investors got their head around it, realized it was a Chinese company listed in the US. It's called Pop Culture Group, and I think I found my new favorite stock because this is a hip-hop promoter. I was looking through its prospectus trying to figure out what the ties were between the US and China, and it said that their service, we aim to promote hip-hop culture, its values of love, peace, unity, respect, and to promote a cultural exchange with respect to hip-hop between the United States and China. So, Matt, even though there's tension between U.S. listings of Chinese companies, this company is a hip-hop company, and they say they will bridge the divide.
Well, I guess that's a lofty goal, and good luck to them as well. I just think the SPAT, the DD SPAT, is so fascinating. Maybe they could have given investors an inkling that that was going on before they listed. Maybe investors are going to be unhappy that they didn't. But really, it's all about oil. And that's the chart that I've brought you here today for our listeners on London DAB Digital. I welcome you as I do that every time at this day, and I'll walk you through what we're looking at. This is the correlation between the price of Brent crude, still the global benchmark, and the S&P 500. And the correlation has been positive for so long. In fact, only once in the past 6 years has it turned negative, in 2017. Now we're negative again here, and this could portend big moves for the future. So if the price of oil continues to rise, is that a problem for stocks because it's a problem for the economy, Francine? That's a good question for our next guest.
It is. It's almost it is the perfect question, not almost. It's the perfect question, and we look at the risk of divorce between, of course, the S&P 500 and oil. So no better person to answer this question than Ludovic Subran. He's chief economist at Allianz. I know Ludovic is also somewhere exotic, I think, in France. So congratulations for all of us that can't travel, Ludovic, from living the good life. Ludovic, when you look at the price of oil, actually, at what point, I don't know if there's a target price that it starts being uncomfortable for central banks?
For central banks, no price should be uncomfortable, right? Because they should see through the headline inflation. But for stocks, for example, the threshold is between $70 and $80 per barrel, because this is where you start to have, you know, the positive effect of the investment cycle, especially in the energy sector, starts to be offset by the negative effect for oil importers and for those companies for which oil can represent up to a point of margin when it comes to, you know, having to use these commodities that are slightly higher. So we are right at the tipping point, and this will be interesting to see how the OPEC and OPEC Plus actually reach a deal that will calm down the market and make all of us have a better summer.
Well, we do want to have a good summer here, and I guess we're going to be using a lot of oil, Ludovic, regardless of the price. What does this mean to the reopening? What does this mean to growth if we start to see $80, $90, $100 barrels of oil?
You know, it means that we will have headline inflation, so we will overshoot by, you know, 10%. Let's say $10 per barrel extra is equivalent to 0.2 additional, so not 0.2 additional on the inflation year on year. So this could actually lift a little bit the expectations on the market, but it could also, and this is where it is interesting, in the real economy, this would add up to an already very heated industrial commodity cycle. So the question is really for those importers on the import bill, and that could be costly for some countries, especially in Europe, like Italy. But it is also for companies, some companies are reporting incredibly high import prices overall, right? And so if the oil prices actually takes another 5%, 7%, you start to really hit the profits and to certainly, this be a major disincentive to more capacities and more investment cycles. So this is important to keep the oil price, slightly below 75, even below 70, to make sure the second half is actually a good one for all of these reopened economies.
With some of the oil price movements that we've seen, at least in the short term, there had been this question to whether it would be sort of the jolt that woke up the bond market. We're not really seeing that. We're still seeing 10-year nominal yields at 142.38. Ludovic, what is the bond market telling you right now? The fact that regardless of the data we're getting throughout the U.S. economy, it's stuck in a pretty tight range.
But it's interesting because in the first, major surge of the U.S. 10-year Treasury yield, most of it, I would say 75% of it, was explained by the commodity market. So this time around, the fact that there is this volatility on the oil price and that it's not triggering any type of steepness of the U.S. yield curve means something that people see through it. So they don't react to it, and they've priced in most of the supply and demand mismatch and don't really take this bluff, this supply speculation bluff for granted. And so I think it's quite good news. It means the market is less, I would say, erratic or less unhinged as it was, 3 months ago when it comes to inflation being a permanent shift for our economies.
Ludovic, I also need to ask you about the ECB. What exactly is the right way for the ECB at this point to look at inflation?
The ECB has given us some insights about the idea to change the inflation calculation, which is a very French thing to say. When you miss your target, you start changing the rules. So they want to include a little bit more real estate prices into the definition. They certainly want to symmetrize the target. So I think for the ECB, the problem is the heterogeneity here again. We may have a third quarter where Germany will actually be above 2% inflation. So you get, for the ECB and especially for President Lagarde, the issue is to have a tight governing council as long as possible. Because this is really what will make it through the March 2022 deadline, which is the end of PEP, and certainly till the fall of 2022, when the political ghosts are actually going to come out again when it comes to the divergence between the North and the South. So it's all about seeing through, keeping the community tight, and making sure, we don't average the inflation target like the US do, but we see through headline turmoil, and we really look at core inflation, which today is still very much in check.
Well, are there places, Ludovic, where you see any structural supply constraints? I mean, Javier Blas was talking about oil maybe as one because the majors are being pushed not to explore and produce as much for ESG concerns and also being drained of their cash for dividends and share buybacks. Are there other pockets of structural supply constraints out there?
I think building material is worrying to us, including actually in the construction sector. Both industrial inputs and labor are under some form of shortages, especially in the US, but slightly also in Europe. I'm concerned personally about the container price of trade, which has been multiplied by 10. And by the fact that those containers are full of electronic prices and not of industrial commodities. So I'm still very much in the camp of those people thinking, it's about a year of normalization, but I still see construction, material, and inputs, and of course, semiconductors, electronics, and chips still being for us on the shortage side. And this is why, what is interesting, right, is that we enter a speculation phase. A speculation whereby a lot of companies, instead of ordering one container, order two, because they don't know what will be the price of the container. And this is the worst that can happen. This should remind us of the 2007 food crisis, where every Asian household was buying 2 kilos of rice instead of 1 kilo, and the price of rice increased by 400% over 3 months, right? So I'm concerned about this, deja vu on the industrial commodities, especially in building materials, electronics. This is why I see the tensions as we speak.
Ludovic, thank you so much. Ludovic, who are you supporting at football today? Spain or Italy?
Anybody
the
but
real
England.
Important question.
I'm sorry, for the final, I don't want to see England. Yeah, that's it. So, I support Italy because they're doing a much better job at tapping into European next generation EU. So I'm supporting Italy for economic reasons.
There you go. There's always a link
Forza
between
Italia,
football and the
Francine,
economy.
Forza Italia.
There you go, Forza Italia. Ludovic Subran, chief economist at Allianz, joining us, as always, in a good mood. Now, coming up, ending the lockdown, easing restrictions in England could mean new concerns for businesses. More on that next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We must be honest with ourselves that if we can't reopen our society in the next few weeks, when we will be helped by the arrival of summer and by the school holidays, then we must ask ourselves, when will we be able to return to normal?
The UK Prime Minister Boris Johnson announcing plans to end social distancing in England on July 19th. Now, face masks will be made voluntary and the government will no longer instruct people to work from home despite a surge in infections. Let's get straight to our Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst. Sam, there are a lot of questions on actually what works for one person because of risk aversion doesn't work for the next. But a simple and hard question to you. Would you go to the Wembley Stadium today to see Italy against Spain? Is it safe to be outside in crowded places?
Yeah, but Francine, I'm assuming that that's a rhetorical question because that's exactly what you're planning to do. Look, it's an outdoor space. I've not been scared of outdoor spaces for quite a while. I'm a double masker anyway, so as soon as Delta turned up, I thought, well, I need a little bit more protection there. So I think the worry I have, I've been on an airplane just last week. The worry I have is that you've got a situation where the arena or the plane itself isn't necessarily the most dangerous thing. It's the monster queue in that tiny little hallway that they line you up to get onto the plane, or the place wherever you go to get into Wembley. It's a long time since I've been to Wembley. So that's where the risk for me is. If you can try and minimize that crowding, then I think you'll be relatively safe.
It's not agoraphobia, Francine. It's anoclophobia. That's the fear of crowds. But it can be overcome, probably with pharmaceuticals or a vaccine. I mean, Sam, if we're vaccinated, why should we be afraid of stuff? Isn't this fear getting to be a little bit too much? Shouldn't we be pushing the other narrative? If you're vaccinated, you're probably going to be safe?
Hey, as I said to you, I got on a plane, but I'll send you the photograph of the area where they were holding people before we were getting on the plane. And honestly, I was very happy that I was wearing my mask with that little additional protection that I get versus an infection, including my. I don't want to catch COVID-19. I don't know what it will do to me with my vaccine in terms of long COVID. I have no idea.
What is the case fatality rate right now among vaccinated populations?
Yeah, I mean, if you look at the latest data that we had from the Public Health England, the numbers are, if you multiply the protection against infection plus the reduction in hospitalizations, it gets you to a very low number. But it's not about death, Matt. I didn't say I'm worried about death. We know that the risk of death, the risk of hospitalization is much lower with double vaccinations. What I don't know is what happens if I catch the infection in terms of its sequelae, such as long COVID, and how long do I suffer, don't I suffer? Why expose myself when all I have to do is put a mask on my face? What's the problem?
Sam, thanks so much.
I thought the mask protect others from you and not you from others. But that would be good if the mask protects you from others.
Yeah, I think both of you have to have masks, Matt, otherwise you have less protection. We'll do diagrams. This is what we do. We look at mask wearing and diagrams. Sam Fazeli there from Bloomberg Intelligence joining us. Now, coming up later on, Bloomberg Surveillance, Ames Adalja. He is Johns Hopkins Center for Health Security Senior Scholar. That's at 6:30 a.m. in New York, 11:30 a.m. in London. We'll ask Dr. Adalja mask wearing. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua and Matt Miller. Kaylee Lyons is off today. Now, Blackstone President and COO John Gray says it's still a pretty good time for real estate. Gray provides his views on a range of topics, including the booming property market, on the first episode of Bloomberg Wealth with David Rubenstein.
Well, if you talk about for-sale single-family housing, there's probably more risk in the sense that you're building something and you're selling it and it's a function of the market. If you're talking about rental housing, think about an apartment complex, that tends to be less risky because it's less cyclical. People don't give up their apartments when there's some volatility, but nothing like, say, office buildings or hotels. So I would say residential rental real estate safer, less volatile. And then commercial real estate involves office buildings, warehouses, which has been the biggest theme for us over the last 10 years, hotels, shopping centers, senior living facilities, and all of them have different risk returns depending on geography.
Another way of looking at real estate are things that are already existing and things to be built. So is it riskier and higher reward to build something, or are you more in the category of trying to buy things that already exist?
We generally are in the business of trying to buy existing real estate at a discount. So we bought the Cosmopolitan Hotel and Casino in Las Vegas, and we bought it for less than half of what it had been built for because it was built during the financial crisis. So that, to me, is ideal. Occasionally, we'll build things, but in general, we like to try to get into real estate at a lower basis when it's already producing income. The problem with development is it's a bit like saying I'm going to IPO 3 years from now. When you show up to lease up your building, we could be in a different economic environment, and therefore you may not have tenants, you may not have revenue. So we've generally biased towards existing real estate.
Well, you can catch the full interview with John Gray on Bloomberg Wealth with David Rubenstein. The show debuts tonight, 9 p.m. in New York, and July the 7th at 7 p.m. in Hong Kong and London. Now, the one and only Tom Keene, fresh back from barbecuing his way through July the 4th weekend. Happy July 4th. I don't know whether, is it a thing that you can still say it on July the 6th? Of course, he's anchor of
You can
Bloomberg
always
Surveillance.
say it. In the great United States of America, every day is July 4th.
Happy birthday, America.
Just a quick note, Francine. John Gray, I'm a huge John Gray fan. This is going to be an interesting interview with David Rubenstein. John Gray is truly one of the young philanthropists of New York City. This is a guy who put his money where his action is. It'll be great to see that. Speaking of money, Matt Miller's Bentayga, his Bentley, I should say, his Bentley Bentayga V8, 44 seconds. It's like 4.4 seconds to get from 0 to 300 miles an hour. Let's go to the chart of what's going to set young Miller back in a gallon of gas. This is not in liters. I'm sorry, Matt, I can't do the conversion. It's too early on a 4-week Tuesday. $4 a gallon. $4 a gallon is a level we've known. Down we go with the great gasoline disinflation, outright lower prices over the years. And Francine, we've really spiked up. This is set in $2021, $3.18 a gallon.
Yeah, wait, hold on. So is Tom Keene and Matt Miller driving up the prices of expensive cars? Is that the bottom line of your?
Are we driving together? Are we going on a road trip?
A road trip. I can see that. I'm going to go south of 59th Street. What I would say, Francine, is we're finally seeing a bit of a slowdown in auto sales. They have been a boom part of this American boom economy.
Tom, I'm looking forward to your interview with Richard Haas and also Dr. Adalja. Matt Miller is saying, auto sales, especially luxury.
There are 3.7 liters in a gallon. I just want to point out that I pay $2 something per liter. So I'm paying $7, $8 a gallon here to fill up my truck. If I had the Bentley Bentayga, I would choose the W12. They make a W12 engine, which is really unique. Yes?
You live in central Berlin. Where are you driving to?
How are you driving
I drive a lot of places. For Steve, I have a European-sized truck, and Steve has a big bed in the back, and I drive them around to all the national parks and the state parks around here. It's what I do after the show every day.
Which, Matt, is why you and Steve, for those who don't know, is his dog, are looking at OPEC. And Danny, you're also watching OPEC.
Yeah, obviously for what it means for Matt and Steve. Yeah, the disagreement, are they going to revive talks? It actually seems like it might be long-term bearish, because if they don't revive talks, who's to say that they're going to continue to have discipline? So Matt, that's what I'm looking at with you and your precious dog, Steve, in mind.
I'm going to actually watch soccer. I'm going to sit down and watch an entire soccer match today, all 90 whatever minutes it is, because, they can just magically add a guesstimate at how many minutes they need to at the end of the game, and hopefully penalties as well, because I think that's probably the most exciting part. I will root for, I'm going to root for Spain. I'm sorry, Francine, because my wife is Spanish,
so this is,
so
what I'm watching. I mean, I'll watch the game, but I'm also watching my family to see how much they love me, whether they're rooting for Spain or Italy. So that's what I'm watching. It's like, the barometer of how much love Francine gets in the Lacqua household. Also, I'm watching the ECB. So there's a strategy review. It's a pretty big deal. We could have some kind of news this week, but they're meant to enter the final stretch of the biggest strategy review today. Officials are looking to hammer out some key differences. Of course, it's the inflation one that's the big one, but really there's a laundry list of what they'll talk about, including climate change and some of the other things that they've put in their monetary policy. So we're watching that. More Bloomberg surveillance coming up next. With the team, they look at treasuries, they look at OPEC, and they look at football. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
businesses have been ready to reopen faster than workers have been ready to come back.
We see a very high number of people who are quitting their jobs. We only see that when people feel very confident about the job market.
I do think we're far enough along that a lot of that scarring should begin to dissipate.
I would argue every data point now is going to be a market event because they've put the market on notice.
We've missed on inflation for so long that the Fed is really focused on achieving its inflation target.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance on radio, on television. Without John Farrow and Lisa Abramowitz, Romaine Bostick coming off the Boston Pops in with us today, and Matthew Miller from Berlin picking it up as well. Lots to talk about. We got some major market moves here. The repo market is something Romaine and I are looking at, and also, of course, the real yield is really something. But Romaine, I've really got to go to a close-like feel here on the Surveillance Open and go to Didi. Matt Miller picked up 8,000 shares of Didi because Farrow was on one of his vacations. Are you kidding me?
Well, Matt had perfect timing here. Exquisite, Matt, here. I mean, this is absolutely stunning here. Not only because the turnaround, I guess, what you're seeing here in the market, the ADR is down 22% here in the pre-market, but now I guess this report out of Bloomberg News saying that apparently authorities in China had actually reached out to Didi at least 3 months ago about delaying this IPO, and now there's a lot of questions here as to why that information wasn't relayed to investors prior to this. The fact that they went ahead with it, there are a lot of reasons. Go ahead, Matt. I mean, because I know you're stuck here.
How about giving me a heads up as an investor, you know, before the IPO, if the Communist Party says don't do it, I need that kind of information or I'm going to be calling my law firm later.
It's a new kind of finance, and I want to go to a subset here, folks, as we try to get the show started. And the basic idea here is, what do you do if you're a Western bank in Hong Kong off of this action? Do you move to Singapore or some other geography as well? That'll be something maybe for 2022 to discuss. We're going to look at the equity market. It's here, a 4-day work week in America, and a lot of it wrapped around what the markets are doing. Romaine, what is your observation as we're 1 week out from the earnings season with JP Morgan?
1 week out from an earnings season, coming off last week's jobs report, you actually have a scenario here where a lot of people do think we can push higher. You're looking at 4,300, 4,340 on the S&P 500. That's pretty much around the average of where most strategists thought we would end the year. You now have some folks nudging their price targets higher here. The idea that there is more left in this tank, Tom, at least here in the U.S.
Abby Joseph Cohen scheduled to be with us later this week. We'll see what she and David Costin feel, the Goldman Sachs view. The VIX 15.83. Looking at the bond space, it's absolutely fascinating to see yield. I want to do the nominal yield here very quickly, 1.4204. Will we get a 199 on 30-year bond? We're not there yet, 2.04. But what I would really look at, Matt Miller, is the inflation-adjusted yield. The nominal yield less the inflation expectation is the so-called residual, and that is completely confounding the zeitgeist of 90 days ago.
Yeah, absolutely. I mean, the big change, first of all, the nominal yield dropping it to like 142 right now, and then a core CPI up above 3% is a real concern, right? So, but you still have people buying this debt because other investors outside of the U.S., this looks so much better than negative 20 basis points on the bunds.
No, maybe there. I'm watching the Swiss 20-year just for Matt Miller as well. It's still positive, but if that was to tip negative, that would be another sign here. One more comment here before we get to Ben Laidler, and that would be on oil. I mean, I look at this, Romaine. What have the oil stocks done? Is Exxon behind Brent crude, or are they out front?
Well, a little bit out front, and you have to understand here, really over the past year, there's been a big disconnect here between the prices that we're seeing actually in some of these oil and exploration companies and the price of oil itself here. Those companies have actually been out in front of this. So the reaction, I guess, the correlation, if you will, Tom, not quite as one-to-one as you would normally think it is here. But this is a major story, and I know we're going to talk about it a little bit later in the show.
I was having the obligatory Cuban seed last night celebrating Independence Day, and all I can tell you, folks, is the guest quality through the week is just something. Stay with us for conversations here on economics, finance, and the stock market. And we start wicked strong, as they would say, in first place Boston. Benjamin Laidler joins us with eToro, their global market strategist, smartest guy on the block right now. Ben Laidler, reaffirm a double-digit 2021.
Yeah, definitely. I think we continue to underestimate the growth recovery. I mean, we're going to go into second quarter earnings next week. Consensus says 65% year over year. That'll be the peak year over year, but I still think we're going to beat that. And I think the next earnings story is next year. Expectations for next year just look far too low, 12%, when you've got 7% nominal GDP growth. So I think there's still upside to this sort of growth story. You know, PMIs are still, at 60, very, very high levels. So I think the growth story has further to go. And that's your insurance policy to the biggest risk which is out there, which is that valuations are still very high. They're going to come down, probably as the Fed sort of gradually tightens here. But I think that sort of growth story is more than going to offset the decline in valuation. So yes.
Hello, traders. Hope you are doing well. Back to business. I'm looking to sell short Bitcoin. As you can see, we still hold 3 positions, 2 long positions, 1 short position. We're already on some positions in profit. And right now, I'm looking to place an order to sell short at 34,406. Okay, if the price will reach this level, I want to sell short Bitcoin. Okay, 34,406. If you're trying to figure out what we're doing, why we're selling, why we're not selling in profit some of the positions, you need to get the strategy. We're not trading a couple of £100,000. We trade in large accounts. So we need to make lots of money, not only for us, for our customers as well. Okay. So the order place I will adjust later on to sell short Bitcoin. Okay. Also, I probably will place an order to stop if it will reach level. I will try to calculate if it will be profitable for us. I will try to place an order to sell Bitcoin at the price 33,342. Yes, I will place an order to sell short, to close position at that we placed at 33,342, and if it will reach to 33,676, this position will be sold. We'll have 1% in profit, and we will collect profit from there, and probably will then buy again at the lower level. Okay, but for time being, for these at this time, I'm looking to sell short, open new position on Bitcoin at 34,406. Okay, I'll speak to you later, guys.
No one's been investing in the commodity space for a decade, so I think you have real supply constraints. But it's just worth saying, particularly on oil, the higher prices go, those are the sort of seeds of its sort of own destruction, if you like. I mean, ultimately, that will incentivize supply to come back to the market. That's going to incentivize even more the sort of move to renewables. So, enjoy it while it lasts. But, ultimately, the market is going to adjust.
Ben, you have been on a magical 3-year tear. There's just no other way to describe it. You've got other people participating in the bull market, but nobody's nailed it like you. Are we overemphasizing the so-called rotation from technology to cyclical? Is that like emphasized too much versus just being in the market?
Yeah, I think so. I mean, I think cyclicals lead here because I think the growth story has sort of further to go. But I think I think you need to be invested. I think the tech story is just a different story. It's slightly longer term. It's a bit more structural. Valuations are obviously sort of somewhat higher. But these are the fortress balance sheets. Very strong growth. I mean, big tech last quarter grew earnings 120%. I mean, it's just mind blowing for companies that size coming off the year they'd already had. And I think it just speaks to sort of some of the earnings power. So, we can have a debate about, what am I prepared to pay for these things? But I don't really have a problem with that sort of earnings power, these margins, these balance sheets, more dividends, more share buybacks. I mean, it's a different story, less sort of juice to the recovery we're seeing right now, but it's still a very attractive story.
Ben Laidler, thank you so much. Greatly appreciate you getting us started here this morning with eToro Global Markets. Can't say enough about the sharpness and terseness of his morning note as well. Romain, you and I, our knowledge of soccer is really weak.
Oh my God.
Miller was dumber than us, and then he went out and married an absolutely gorgeous Spaniard, so we know what he's doing today. Matt, is it true that if the next son is issued, you're going to name him Ferran Torres Miller after the great Manchester City wing for the Spanish team? Is this true?
It will be a debate in our household. I'm for England, which is almost treasonous to my wife. She is literally in Spain right now, getting ready to watch the game tonight. And if they lose, she might not talk to me for a few weeks.
I mean, it didn't work out for Henry VIII, Matt, would be my brief here. This is a lot of fun. Matt Miller, tell us what Euro 2020 means for Berlin. What's the tone there? Is everybody focused on every individual game, or is it every country for itself?
Well, I mean, Berlin is an incredibly international city. Nonetheless, the media absolutely excoriated Jochen Low, the German coach, the German manager, when he lost to England. But yeah, Berlin is mostly hipsters from Brooklyn and from the city of London. There are fewer and fewer Germans here than you would imagine.
Very good. Matt Miller with the analysis from Berlin. Romain, we got through that. Do we have to do it again here across surveillance
I think that covers our soccer portion.
I don't think
Car talk is coming up. Car talk is coming up.
Obligatory car talk and even bit dog talk here at the end. What's so important to note here is this is going to be a lot of fun. Italy and Spain today. I believe Mr. Farrow is focused on a different team than Mr. Miller's focused on. My deepest sympathies, Matt. I can't imagine what Mrs. Miller's thinking right now.
Is anyone rooting for Denmark?
Yeah, no, Denmark will do tomorrow. Jens Nordvig is totally pumped.
Okay.
Dan Alpert coming up. Must watch and listen with Westward Capital. Alpert on the age of oversupply.
With the First Word News, I'm Rishika Gupta. Oil jumped to the highest price in more than 6 years today. That's after a bitter fight between Saudi Arabia and the United Arab Emirates blocked a supply increase and plunged the OPEC Plus coalition into crisis. The coming days will determine whether the battle will escalate into something as destructive as last year's price war. In the UK, business lobbies cautiously welcome Prime Minister Boris Johnson's plan to ease coronavirus restrictions on July the 19th. Still, there's a heavy dose of skepticism. It's good news for pubs and nightclubs, but there's also the issue of liability surrounding infections in the workplace. President Biden and Russia's Vladimir Putin face an early post-summit test in Syria. An agreement over international aid corridors into the country is set to expire this week. At last month's summit in Geneva, President Biden asked Putin to keep aid flowing into Syria. That will require the two nations and other members of the United Nations Security Council to reach an agreement. In South Florida, rescuers searched through the rubble after the last of that collapsed condo building was demolished. That allowed crews into previously inaccessible places. 4 more victims were discovered, raising the death toll to 28 people. Another 117 are still missing. Shares of ride-hailing giant Didi plunged in pre-market trade in the U.S. Chinese regulators have ordered that the company's platform be removed from app stores. Beijing has tightened its grip on sensitive online data and cited security risks as the reason. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We never again want to be where we were a year ago today. So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives. It no longer paralyzes our nation. And it's within our power to make sure it never does again.
Symbolism is everything, and on the 4th of July, the 245th anniversary of this nation, what we see at the South Portico from the president, so different than what we saw from the previous president. Mr. Biden with the stark single American flag, and the flag of the office is, well, more low-key, more subdued than what we saw in the previous 4 years. A different 4th of July at 1600 Pennsylvania Avenue. Romaine Bostic and Matt Miller with me, John Farrell and Lisa Bramwitz. Off. I think John Farrell may be on Crete. I'm not sure about that. It was a big debate about the Greek islands the other day. Giving us huge assistance on the Greek islands was Anne-Marie Horton, who wishes she was there. She's in Washington, hot, steamy, and what's known as the summer of Washington. I mean, it's an odd day. The 4th of July coming out of it, Anne-Marie, is so odd there. And I love what Paul Krugman said off of the jobs report, that it's a morning in Joe Biden's America. Does President Biden have the time now to celebrate?
Well, good morning, Tom. You know, part of that speech he gave over the weekend, the 4th of July speech,